Welcome to the afternoon session. Our second panel of the day will be moderated by Andre Owens. Andre is an alumni and friend of the agency. He is currently a partner at WilmerHale. He chairs the broker-dealer compliance and regulation practice and co-chairs the security financial regulation practice. So we'll do the second panel, be joined by the chairman probably around 2 o'clock-ish, and then the third panel will close us out. So Andre, take it away.
Thank you, Jamie. Good afternoon, everyone. As Jamie said, I'm a partner at WilmerHale. I wanted to thank the commission and the staff for putting this roundtable together. The first roundtable panel was fantastic. It's been 20 years since the adoption of the rule, and I think the one thing that everyone would agree on is that's long enough to revisit an important rule like Rule 611. So our panel is going to focus on the role of the trade-through prohibition in today's market structure. We're going to touch on a variety of the issues. A number of them are going to be similar to the topics that were discussed this morning. We're going to talk about the objectives of the rule, whether or not they're being met today. We're going to talk about the intersection of trade-through prohibitions and the duty of best execution, of course, and then some ancillary rule, locked and cross markets rules, subpenny rules, and things like that. We've got a fantastic panel today. They represent a number of different organizations ranging from exchanges to institutional firms, retail firms, execution-only broker-dealers, global market makers. We've got an esteemed academician you'll hear from in a little bit, and we've got a nonprofit firm that focuses on education of investors and reform of the market. So really great group. And I'm going to ask each of the panelists to just take a couple of minutes and introduce yourself. And we'll start with Jim Angel from Georgetown.
Why, thank you. And I want to thank the commission for holding these roundtables, and thank all my fellow panelists and thank all of the audience as well. My name is Jim Angel. I'm a finance professor at Georgetown, and I'd like to say a few words about the OPR. In the first panel, we had the image of the market structure octopus, how all these things are interconnected. The order protection rule was really scaffolding on the national market system. When you build a building, you often have to put up this temporary structure that's kind of all jerry-rigged and stuff to put it together. But once it's built, you can take the scaffolding down because you don't need it anymore. Now, the beauty of the order protection rule is it forced the U.S. equity market to become automated and interconnected. That is not going away. If we take that scaffolding away, it's not as if suddenly all the interconnections will go away, all the automation will go away, and the 1,366 seat holders of the old NYSE will come out of retirement and start yelling and screaming at each other on a wooden trading floor. So we're now in the modern world. We don't need that scaffolding anymore. Why should we get rid of it? It adds a ton of complexity to the market. All of the debates over what quotes should be protected, which ones should not be protected. I personally believe that best execution obligations are sufficient to make sure that investors are protected, and we can do without the unneeded complexity. But I've only got a minute, and I want to hear from my fellow panelists.
Great.
Thank you.
Thank you, Jim. Next up, we have Allison Bishop from Proof Trading.
Hi, thank you very much for having me, and thank you all for being here. I'm Allison Bishop. I'm co-founder and president of Proof Trading, which is a small startup agency broker-dealer for U.S. equities. I'm also a part-time professor of computer science at City College, where I study adversarial systems, which might be relevant to finance just some of the time. So I am looking forward to giving the perspective of especially transparency around costs from the perspective of broker-dealer, small broker-dealer competing in this space. In the first panel, we heard a lot about how these things are tied together with connectivity and market data costs, which are often kind of lumped together. But from our experience, actually behave very differently because of the sort of way that the market ecosystem has provided connectivity as a service that's available to broker-dealers relatively cheaply, but market data is still a huge cost, and we really appreciate and rely upon the quality and accessibility of the SIP. And so I think to the extent these issues affect the role of the SIP going forward, that's something we're very interested in adding our perspective on.
Great, thank you. Thank you, Allison. Hubert Jesus from BlackRock.
Hi, my name is Hubert DeJesus. I am the head of electronic trading, research, and market structure on behalf of BlackRock's markets organization. BlackRock is one of the large asset managers globally, and we are a significant participant in markets across the globe on behalf of our clients and investors. I wanted to take the opportunity to thank the Commission and the staff for the opportunity to come and discuss our views on the trade-through prohibition. And I think at the outset, it probably makes sense to note that Reg NMS, and in particular Rule 611, has been very instrumental and beneficial in integrating independent marketplaces into the cohesive market system that we have today. And as a result, it makes sense to note that U.S. equity markets function exceedingly well today, and as was highlighted earlier in the panel, are fairly widely admired around the globe. Now, while certain aspects of Rule 611 may contribute to market fragmentation and increased costs in today's market environment, we think that trade-through prohibition is very closely connected to a number of other provisions in Reg NMS. So similar to kind of taking the keystone off of an arch, you kind of want to make sure that you're adjusting all of the other rules in Reg NMS to make sure that we're not introducing unintended consequences by eliminating or modifying Rule 611. We would suggest that the SEC should consider a balanced approach where Rule 611 could be refined to address fragmentation and costs by introducing a market share threshold. But this needs to be accompanied by corresponding adjustments to other rules that would address additional economic incentives for exchange proliferation and market fragmentation.
Great, thank you, Hubert, appreciate it. Next is Armando Diaz from PureStream.
Great, thank you. Thank you to the SEC.
There you go.
Thank you to the SEC for the honor of contributing to the discussion. I'm Armando Diaz, the CEO and founder of PureStream, an exclusively institutional ATS. My views on 611 are influenced by two primary experiences. The first is a 30-year career that spans NMS, pre and post, most of it post. And second, my firm's experience in introducing a novel trading protocol called streaming. Streaming involves referencing trades market-wide in real time, as opposed to just referencing the midpoint of the NBBO. We are essentially co-located on the SIP, or think of it as virtually co-located on the SIP, and we are producing high-fidelity replication of market prices in any fraction or multiple that participants can match at on our market. Referencing trades gives us a unique insight on 611. In our experience, trade-throughs occur exclusively off-exchange, and as such, we filter each and every trade occurring off-exchange for trade-throughs. We did this 50 million times yesterday. Our data suggests trade-throughs occur at roughly the rate of the SEC's non-1-second look-back. That does not include locked and cross markets. Importantly, our view is the impact of the excluded trades, or the trades that we don't reference, is de minimis, unlike the inception of the trade-through rule, where trade-throughs were more frequent and of higher impact. Especially through the lens, and in particular, especially through the lens of institutional best practices on best execution, which is looking at the weighted average of all executions. The last thing that I would say is, as we look through market structure, I think it's, and of course I'm biased on this given my career, but I think it's important that we all, irrespective of what stakeholder you are, recognize that the institutions are the only participant that is constantly cycling through the market structure that we have. Retail traders are done in one trade. Corporates trade before or after the close. And market makers, the smaller NBBO or the tighter spreads, the vibrating NBBO suit them well. Institutions are the only ones that have to live through that. So I think that is of particular importance for everybody. And thank you again for the opportunity to participate.
Thank you, Armando. Next, we have Jonathan Kellner of Members Exchange, MEMEX.
Thank you, Andre. Thank you, Jamie, for having me. I'm Jonathan Kellner, the CEO of MEMEX. MEMX was created in 2019 by a diverse group of market participants, many of whom are on this panel and several panels today, who recognized that there was a lack of competition in the exchange landscape and felt that there needed to be an exchange operator that was clearly aligned with the need of market participants. Today, MEMX operates an equities and options exchange, and we also provide our market technology to other market centers. MEMX believes that a vibrant, healthy capital markets ecosystem is characterized by both a strong NBBO and significant amount of displayed liquidity. If the SEC uses these two objectives as their main priorities when undertaking market structure reforms, we are confident many paths forward could be successful. For example, if we keep 611 as is, or even with some targeted exceptions, then more modest market structure changes like implementing the already approved tick size changes may suffice. If, however, the Commission votes to remove 611, then it will need to evaluate ancillary rules like access fee caps and locked and crossed markets, as well as broader market structure rules like fair access, that if left alone, run the risk of moving flow off exchange and into the dark. MEMX can be supportive of either path, as long as the SEC takes care to ensure that its overall regulatory regime continues to promote a robust displayed market. I look forward to participating in the dialogue today and appreciate the Commission for working with the industry to strengthen our market structure.
Thank you, Jonathan. Appreciate that. Kevin Kennedy of NASDAQ.
Thanks, Andre. Good afternoon to Chair Atkins, to Director Selway, and to our fellow panelists. Thank you to the SEC Trading and Market staff for convening this important roundtable. We appreciate the opportunity to share our views and engage in dialogue about improvements to the U.S. equities and options market structure. In my current role, I oversee North American markets for NASDAQ. That includes our Canadian equities markets, our 6 options exchanges, our 3 equities exchanges, our economic research team, and our operations. And in that role, I do want to share one little anecdote because it'll play in later. So yesterday, because I like talking about myself, it was my 38th anniversary of trading as a professional in the markets, on the options market. So I got the start on September 18th or 17th, Constitution Day in 1987. And the reason that's important, and we're going to talk about it later when we get the options, because I think Chris Isaacson did an impeccable job, but I want to bring even a little more perspective of how important, when we think about these things, we think about markets that can really be stressed. We've done really well over the years with COVID, with the financial crisis, with everything, but we have to prepare, and we'll talk about this largely in options and why we'll have maybe some diverging views, but I just wanted to share that one anecdote. So at NASDAQ, really important, we actually are closely aligned with the Commission's goals of reducing both the complexity and the regulatory burden with our markets. We all talk about the regulatory burden. We like to see it go away. There's actually leadership happening with this team at the SEC, with this administration, and we welcome that. We believe that simplifying the rules, of getting rid of the complexity, and moving away, really important, moving away from prescriptive fee setting. That's really important, and ensuring a level playing field, even in off exchange, let the exchanges compete. All of those things will foster greater competitiveness. And that's what we're here for: lower investor protection, more competition, and lower regulatory burden. So we believe enhancing our markets is central to our mission. A vibrant and competitive marketplace supports corporate issuance, fuels capital formation, and empowers investors to succeed. These pillars are fundamental to a healthy financial ecosystem. So we look forward to working with everyone to ensure the United States, and we've heard this a few times today, but the United States does remain the premier destination for investment and innovation. Thank you.
Great, thank you. Matt McKenzie from Optiver.
Thanks, Andre. Thanks, Jamie, and to the Commission and staff for all the work that went into setting today up. We really appreciate being invited. My name is Matt McKenzie. I work at Optiver. Optiver is a shortening of the Dutch words for options trader. If you asked me to say those words, I would mess them up, and it would take 15 minutes. So we're going to stick with Optiver. We're a global market making firm. Our history and heritage is in options, but we trade all products. We also trade equities, and we do so globally. So we have a perspective that's informed by markets that have this rule and markets that don't. And when we think about changes to the market structure and the rules in the US, I think the first principle that comes to mind is do no harm. And in the option space, as has been discussed ad nauseum, there's some real strength there that we think those options markets might be better suited to digest a change of this magnitude if it were to be repealed. And on the equity side, we just really would take that do no harm approach, or suggest it, and focus on the way the trade through rule is threaded throughout the things that it supports, the MBBO, best execution, a number of other rules that we can discuss at a later point in the panel. But as a fundamental value of the firm, we really believe in lit liquidity and trading on exchange. That's really where we find the value proposition. And so we would not want to see changes that the SEC would make that would disincentivize that liquidity provision on exchange. And so we have some thoughts around that I'm happy to share later. I would like to point out, I was instructed to do 2 sentences, so that's all I prepared. Thank you.
It's great. Thank you. Thank you for following instructions. So I think Chris Nagy's next from Healthy Markets.
Thanks, Andre, and thanks, Jamie and Ted and the entire commission for having me here. Excited to be here representing some views. My name's Chris Nagy. I am the head of research at the Healthy Markets Association. We're an investor-focused trade group that includes public pensions. We're talking a lot about the unintended consequences of Rule 611 today, but it's almost like we forgot why we have it and why we still need it. I'm old. Actually, I've been in the business a little bit longer than Kevin. And I'm old enough to remember while I was the head at a large broker, before it was adopted and after, the improvement to investors was pretty extreme. I recall markets being locked and crossed, my customers not getting executed on their orders. I recall my customers getting their orders filled at prices that were far worse than the displayed prices. I recall begging the SEC for help, and you can look at the public record for that. We all needed a backstop for best execution, and that's kind of what OPR is now. Trade-throughs are rare today, and that saves customers billions of dollars. But there are a lot of ways the rules could be improved to mitigate the negative impacts on data and access costs, and I really hope to talk about that. Also on the potential information leakage. However, any weakening of Rule 611 must be accompanied by improvements to best execution. We should have rules such as 605 and 606 implemented first. We should require any trade-throughs to be disclosed and quantified on trade confirmations for customers. Similarly, the Commission should also add odd lot orders to the SIP immediately before doing anything with OPR. The Commission should consider a block trading exemption, but that should also be accompanied by an explanation of any trade-throughs. The Commission should consider a depth protection. The Commission should consider applying protection to all material venues and should exclude from protection voting in NMS plan profit venue for venues under 1%. Lastly, the Commission should further lower access fees and distortive incentives. Again, I'm old. While HMA has been commenting on potential changes to Rule 611 since we first launched, I've been working on these issues since before 611 existed. At the heart of it, Rule 611 is really about best execution. Let's not screw that up.
Thank you. Thank you very much, Chris. And then we have Adam Nunes from Hudson River.
Yeah, thanks, Andre. Thanks, Jamie, and the commission and the staff. So I'm Adam Nunes from Hudson River Trading. Hudson River Trading is a market making and trading firm that trades in markets around the world. I guess just a few thoughts without getting into any of the specific issues. Hudson River Trading at the time of NMS didn't think there was a strong rationale for the order protection rule and trade through rule then. And I think kind of largely for the reasons that Jim laid out, we think the rationale today is even weaker. So in general, we think that market forces, competition, and innovation have already solved a lot of the problems, and you saw that in some of the data that the SEC put together on pre and post market. That what were numbers of trade throughs that I think were in the 2 to 3% using a 3-second look back window at the time, are now like far below that pre post market where there is no prohibition against trade throughs. So we think that the evolution of the market from, at the time, what was really the collision of manual markets and automated markets that, was the primary driver of NMS. And one of the causes of that collision, or one of the things that exacerbated it, was there was a trade-through rule. I think that was kind of viewed as the biggest problem at the time. And the solution was a different trade-through rule. And built into that trade-through rule was you can trade through manual markets. So I think when Jim talks about the scaffolding and the catalyst to move markets to automated, we're now there. And I think we have to look at the trade-through rule through that, through that prism.
Great, thank you, Adam. And finally, Jeff Starr from Schwab.
Thanks, Andre. Hi, everyone. I'm Jeff Starr. I lead operations at Schwab. That includes the teams that are responsible for order routing and execution quality across all asset classes. We really appreciate the chance to be here today and represent the voice of the retail client. We think that there's always room for innovation. There's always room for improvement when we look at these things. We just want to make sure that we do it in a way that preserves what we think is a world-class experience for retail clients today.
Great, thank you. So we're going to touch on a lot of the questions, a lot of the topics that the panelists mentioned. I just wanted to take a second to level set mainly for folks who might have missed this morning's session. So we're talking about Rule 611, which is intermarket price protection for published quotes. And there are a number of exceptions to the rule, including self-help exceptions for material delays, intermarket sweep orders, benchmark exceptions, flickering quotes, and the like. We're also going to touch on the options market, which has its own options order protection plan. We're gonna try to intersperse that discussion of options along the way rather than do it separately. But we are going to talk about options for a bit. In looking back at what the market looked like in 2005, this was sort of touched on earlier today. We had 9 SROs, 9 exchanges, I should say, NASDAQ, and about 10 ATS/ECNs. I guess they were all ECNs back then. And the listed company market share was heavily concentrated on the New York Stock Exchange. There was a trade-through rule that was mentioned a little earlier. It was the ITS plan rule, which was antiquated to say the least. Had an exception for 100 share orders and opt-out for large orders. On the NASDAQ side, trading was more dispersed. The ECNs had gathered a pretty good share of NASDAQ's trading volume, in part, I think, because there was no trade-through rule on the NASDAQ side. And so if you flash forward to today, which is what we're really focused on, we've got a very different market. We've got 28 exchanges total, 16 equity, 12 options, 33 ATSs that trade NMS stocks. The split between on-exchange trading and over-the-counter trading is roughly 50-50, roughly. The volume of exchange-listed stocks to trading is much more dispersed. So we're going to talk about some other rules. Folks mentioned the locked and cross markets rule, which deals with making sure there's fair access to quotes and the fee limits. And we're also going to talk about Rule 612, the sub-penny rule. Those last 2 rules, as you know, are subject to litigation in terms of recent amendments that the commission made to them. So I wanted to start broadly. So I wanted to ask whether or not the panel thinks that the trade-through prohibitions have served their objectives in our current market. So the 2 main objectives being encouraging the display of limit orders, and the second being sort of minimizing the extent to which marketable orders are executed outside of the best available protected quote. Can I start with Armando? Do you want to speak to that?
Sure. I think the symbolism of the rule cannot be, at the time, can be overestimated. As I said before in my opening remarks, the magnitude of trade throughs, or the impact of trade throughs, was materially more significant back then. The notion that all markets prices would be equal when there were two dominant markets also cannot be understated. Unfortunately, as appropriate and necessary at the time, it has a major shortcoming in not having protected the depth of the book. And fast forward to today, we have incredibly well-integrated markets. The word fragmentation, I understand how people use it. The markets are not fragmented. Fragmented means isolated, separate. We operate on one protocol. They're all accessible. So we have a very, very cohesive network. Think of data networks. Data networks are materially larger than the trading network that we have. But we missed an opportunity in terms of depth. And currently, the markets don't suffer from efficient price discovery. They suffer from efficient throughput of what people want to do. And for everybody that talks about lit markets, one thought experiment to have in the back of your minds is how much of what people want to do is actually making it its way into the marketplace. And there is a tremendous amount of latent liquidity that is sitting on desks. And we fundamentally have to make a decision as to whether we want more lit markets, tighter spreads, or more liquid markets, and remind ourselves that liquidity is a ratio of how much volume can trade per price point. And I think that we're off balance on that, and that these rules have to be addressed at a minimum.
Great, thank you. What about the exceptions to Rule 611? Any thoughts there on whether or not we need new exceptions or whether or not the current exceptions need to be tweaked?
I'm happy to jump in, Andre. Well, first of all, let's look at the trade through rule itself. Okay, it's a very impractical, and it's not impractical. It's an imperfect prophylactic protection for investors against bad prices, right? And if you go back in the record, before I was old enough to sign comment letters, I'm included in the chair's dissent on Reg NMS. But the fact of the matter is once 611 came into place, it worked, and it still works today. And instead of saving investors millions, it's saving investors billions. I also remember, to the unintended consequences, one of the biggest things I fought every single day was these locked and crossed markets. Back then, in my day, you look, it was a QQQ, it was Microsoft, Oracle, whatever. You looked at a stock, it was in a locked market, 40+% of the trading day. My execution venues, some of the same venues exist today, would not execute in a locked or cross market. So the order would sit there unexecuted for a very long time. What happened then? It led to a lot of calls coming into the call center, and they'd look to me, Chris, what's going on? You deal with these market centers, what's going on with the markets? And I would go around lecturing people on this is a locked market, this is a cross market. I in turn then actually would go to the SEC and try to explain these issues. So Rule 611 of Reg NMS has a lot of these other parts associated with it. Locked and cross being one. But again, Rule 611, what it was really designed to do was to create a best execution backstop for investors so that their trades wouldn't go unexecuted, so that they wouldn't be in a situation where they got a bad price. And it worked, and it still works to this day.
Jim, did you have?
And then there's the biggest exception of them all, which is odd lots. As we heard in the morning panel, 70% of trades now are odd lots, and they are not protected at all. So I think this shows us how broken the rule is and how we need to either fix it or scrap it.
So maybe I can add a few things. I think one, just getting back to the first question on encouraging, displayed limit orders. One of the themes of the first panel was the growth of like non-displayed. So you do have a great deal of people actively opting out of that protection. And, obviously nothing happens in a vacuum. NMS doesn't stand alone. There are other dynamics at play. But we're definitely seeing that not be like such a strong attractor of limit orders. So it's unclear how effective that is. I think as it gets to exceptions, if we have to keep on layering exceptions onto a rule, I think we should admit that the rule's broken fundamentally and that it shouldn't require so many exceptions to make workable. I think some of the exceptions that exist around ISOs, around self-help are more practical. And, I think particularly if you go back in time at just the resilience of markets and market centers, clearly necessary. Today it's still necessary. Fortunately, it's necessary a lot less often than it was at the time. And then again, to Chris's point, I think some of this has been evolved away. I think the notion today that market makers would stop executing retail orders in a locked market is probably untrue. And I think overall, first on cross markets, I just don't think they're going to be an issue. I usually don't know if I should buy or sell a stock at prevailing market prices. When the market's crossed, I know exactly what to do. You buy low, sell high instantaneously, and you get to make money. So I think that's going to be
used to do that.
I think that's going to be arbed away. I think on the locked market side, like I do think that the market, especially with current, access fees and pricing, the market would be locked. I don't know what percent of the time, but certainly much more often than having it prohibited, because economically it's not a locked market. And I think that does have implications on the retail side. I would note we all get really happy as spreads asymptotically approach zero. And then for some reason we lose our minds when they hit zero. And I don't think that's such a bad thing. Think about the amazing zero spreads that we could have in the stock market.
I mean, part of if I recall correctly, part of the rationale for the lock and cross markets rule was that investors would be confused. They wouldn't understand what to do.
And it's been my experience that when people don't have a good argument, they love to point to investor confusion as the argument.
Yep.
And maybe just to bring the retail perspective today into the conversation, a client that places a limit order on our platform today, 97% of the time when the price hits or trades through that price is going to get an execution today. So it's very, very rare and infrequent that we end up in a phone call with the retail client trying to explain the intricacies of an intermarket sweep order. It's functioning very well, locked and cross markets, as Chris and Adam just said, for retail clients are almost non-issues in the market today. And to the point about odd lots, from our perspective, whether it's a round lot or an odd lot, that 97% holds. We don't see any really difference in odd lot limit orders that are out there. And I think you heard the same thing from Pankill earlier when he was talking about the Bank of America retail order flow. So that's the backdrop, I think, that we're operating against when we talk about the retail marketplace.
Thank you. Matt?
Thanks. Just to offer another perspective on Adam's point, we do operate around the world, and including in Europe, where these rules don't exist. And speaking to the head of one of our equities desks in Europe, he noted that when markets are crossed or locked in Europe, they get very quickly unlocked and uncrossed. So just another perspective on I guess amplification of what Adam was saying.
Yeah, thank you. Hi. Yeah.
Andre, can I just chime in a little bit and where Chris was coming from? And I read your letter. I think it's great, but I think where Chris and he brought up, we're very similar because we've both been in this business for a while. But where I differ with Chris is I think we need to adapt and look forward. Like, I don't want to just look back, especially when we know, especially in U.S. equities, where there is a problem. There is off-exchange growth. This is not the classic, we're bringing a solution to a problem that we don't know. We have a problem. We have a problem with off-exchange trading. And what this did is it stifled innovation because we can't compete in the off-exchange space. So it stifled innovation. It had prescriptive fee setting. So I'm willing to say, let's adapt, let's evolve. I love the leadership coming out of the SEC on this, and I think we're very, very open. If it's aligned and we're doing everything correctly, that we can compete and you have to evolve. You have to adapt. And I'm going to have a little bit different take in options, but it's different because in options, I want to steal it all, but there is a problem in U.S. equities.
Yeah, so let's get to options. That's the next.
Can
next
I
thing here.
jump in
Oh,
on
I'm
that?
sorry, John.
Real quick, because I just want to say, I actually agree with Kevin. I think things need to evolve. And if you read my letter, we've got a number of suggestions in that letter on how to evolve the markets. What worries me is that we're not focusing, and we've got enough intellectual brain power in this market structure brain power in this room to solve for this today. But what worries me is that if we don't address Rule 611 for what it is, which is a best execution rule, and in that vein, the previous chair, would say, we don't have a best execution rule at the SEC. Actually, that's what 611 is. If you just remove it without addressing or strengthening disclosure and best execution, then as I say, and as I've seen firsthand, things will gravitate towards the lowest common denominator. And that's what worries me about just blatantly removing the rule.
Yeah, so Chris, we'll come back to best.
Yeah,
Jonathan.
so we've heard a lot just now about innovation. We heard a lot this morning that the exchanges don't innovate. I'd say, first of all, we've been around 6 years. We've built new technology. My CTO is here. If he's not innovating, I think I'm paying him too much. So we are doing a lot of innovation. The exchanges innovate a lot around providing fair markets, fast prices, orderly markets. What we aren't able to innovate on is around market structure. And that is a function of the regulatory regime. But I do caution us to say that, and I agree with Kevin, that let's open the door and try to be able to compete. But just by removing 611 doesn't take care of the problem of our inability to compete on exchange. There are other rules like fair access, or how fair access has been interpreted by the commission, that prevents the exchanges from competing with a lot of what is going on in off-exchange pools under Reg ATS. So if that's what we're looking to do, we need to really think about what rules we want to change or what rules we want to adapt or pull away so that we can have fair competition across the venues and on exchange.
Got it. Thank you. Before we move, I did want to get to the option side of this. So I'm curious as to whether or not folks think that there's any difference in the effectiveness of the order protection rule. Well, not the order protection rule, but the options trade through plan on that side. And why don't I start with Kevin, and then I can go to Matt.
Thanks, Andre. And I sit next to Matt. We may differ on a few of these things, but I really value Matt's opinion. Optiver's been out there, very progressive. I think they bring a lot to the table. So we might disagree with a few things today, but I want to give a little ad, of course, because Chris Isaacson, again, did an exceptional job, and he talked about the growth and the momentum that we have. But I just want to make sure everybody listening to this understands that the top 11 days in history in U.S. options, equity options trading are all this year. In 177 days that we're into this year, that's where they occurred. Four of the top 7 in history have occurred since August 18th. And that's with a VIX no higher than 17.17. So we're not sitting here rooting for a collapse in the market and the derivatives business will get busy. We have an incredible treasure that we've developed over 40 years. And my concern is, and Chris laid out the 1.5, 1.7 million strikes, the securities. You need intermediaries to provide liquidity, to open the markets, to close them. There's great liquidity. And you know who provides great liquidity? Retail orders. Retail orders are posted in the equities business. We know in the equity derivatives business, we know exactly where they're posted. There's customer priority on a large majority of those exchanges. We don't want to trade through them. And what I worry about, you start trading through, and this goes back to 1987. We're not going to hit 1987 again, but we're going to have times that are turbulent. And you don't want customers to say, I don't understand. I was bidding $4. They traded many at $3.80 away. That will happen in the options markets. We need to retain customer priority, for lack of a better word, but order protection to that customer. So I am just like in equities. We will keep a very, very open mind. I love sitting down with Joe McCain's team, Matt's team. We will sit. Let's continue to talk about it. And if you want to move that ORF reform up to, I'll come in even Christmas Eve this year, Jamie. But we already have a filing out there because that is the problem with fragmentation in the equity options business. It's the ORF. and we're addressing it. We have our filing, others are filing suit. I know SIBO has been very supportive, but we have a lot to talk about. So we'll be here anytime. I'll let others chime in.
All right, Kevin, so it's a roundtable of one, Christmas Eve.
I am in.
We'll
I am
we'll
in.
see you there.
Matt, do you want to?
Yeah, well, I mean, maybe two. I'd show up, we could talk. Yeah, I think to build off one of the points that Adam made earlier, when you looked at the data and really applaud the staff for the data that they put out, the number of trade throughs and options linked to multi-leg orders, like the complex order types that we have, the exception essentially starts to destroy the rule. And so, I do think that when we look at the structure of options, the fact that it's listed and traded on exchange, that there is no sort of dark competitor to it, we feel like that structure itself might be best able to handle the end of the trade through rule, given the fact that the exceptions themselves are going to need to stay in place to address the way people trade in options, which is those multi-leg strategies. But to speak to the real issue that we have, and we have a paper, you can find it at optiver.com/insights. We wrote about the options regulatory fee last year, and definitely support the work that NASDAQ and SIBO have done to move this issue forward. We do think that across these venues that has become an impediment to really robust growth, and to forward progress in options for the amount of exchanges that are there and what that fee really entails for market participants. And to be clear, we're members of all these exchanges. We're connected to all the exchanges. We do have costs and complexity associated with that we're willing to do, because we really do believe in providing liquidity and making markets 24/7. No, not 24/7. As much as possible. But I will say that that fee has acted as a real impediment. So it's definitely something we want to see addressed. And if the commission is interested in opening up market structure and taking on this rule in options, we really do think that's one of those issues that should be addressed concurrently with that.
I guess one of the issues on options, as Kevin was talking, I was trying to count on my fingers how many options exchanges he operates. And I think I was running out of fingers before I got there. So, one of the pieces, just the proliferation that we see across equities and options is the same. I also just want to kind of flag the notion of trade throughs goes against market participants' general self-interest. Like, people want to trade at the best price. And so we have self-interest for firms who don't have like a best X obligation if they're trading on their own account. And we do have a best execution rule. I agree that is a rule that in the absence of NMS should and needs to be like revisited. But that does exist. And, there's a version of the world where we have a trade through, and that trade through is justifiable and can be justified. We have them today. That's part of the justification process. So, I don't think that we should be scared to think about a world in which it doesn't exist. As Matt said, it doesn't exist in Europe, doesn't exist in several Asian markets with competitive exchanges. We're the outlier in the world.
Great, thank you. So I want to move on to
Sorry, there's one point I wanted to make sure that
very quickly.
Yes, that Kevin could make, which is there is a caveat to all of this that pertains to floor trading, and that happens at options.
We'll have that panel on Christmas Day.
Great. Okay. So I wanted to get to this topic of cost and complexity, which we've touched on a little bit. When the rule was proposed and adopted, there was a lot of criticism that it was going to introduce unnecessary complexity and costs, and we heard some figures from the first panel about some of those costs. The final rule was simplified in some respects to deal with some of those, so they went with the market BBO rather than depth of book. But can we just talk for a little bit about what the costs are, and to the extent you agree with the estimates from the first panel, that would be great to know. We talked about connectivity costs, market data costs, compliance costs. And I'm just curious as to whether or not this panel agrees with some of what was said earlier in terms of the costs that are incurred today. We can start with you, Allison.
Thank you. Yeah, just wanted to add a little bit of context to that great data that was shared this morning in terms of connectivity costs for brokers in particular, because I think it does show that the market has sort of worked around this issue of all brokers having to connect to all venues and provided various market solutions, including direct market access, which Proof uses. And that cost regime, I think, is reasonably controlled by the effect that connectivity can be resold. So you do have sort of market forces sort of bringing those connectivity costs down. I think market data is very structurally different because in the cost regime we have for market data, everyone keeps getting charged back to the original provider no matter how many times you pass it through. And so sort of even if you're getting market data from a competing consolidator in the potential new SIP plan, that cost can only come down as much as that initial bill that's still due back to the SIP operator. And so for a small competitive broker, we are able to control our connectivity costs reasonably well by going through other providers for connectivity. And I would differentiate that from execution because we do have our own execution algos and our own trading logic. This is just strictly a connectivity service, but that's not possible in market data. And to contrast what was said in the panel this morning about the market data costs in Canada, we do have our alternative here being the SIP. And so I think maintaining the quality and improving the quality of the SIP and affordability is a great sort of support for effective competition among brokers. And in particular, if you're looking for a way to make it less profitable to own a small exchange and more profitable to own a small broker, you could make the SIP less expensive. And that would be one very sort of easy way to reduce the subsidy to exchanges. And I think all the things we've talked about in terms of SIP enhancements, of adding depth of book, adding auctions, adding odd lots, all of those would be great as long as we don't allow the cost to keep increasing, because as we're all worried about exchanges being so profitable from SIP revenue, maybe that's an admission that SIP revenue is way out of proportion to costs. And sort of controlling that, I think, would reduce a lot of these negative effects that we're potentially blaming on the order protection rule.
Thank you. Jeff, did you have anything?
I think when you think about cost and complexity, there's two sides of that, in my view. We saw this morning from the presentation given by the SEC staff, the cost and complexity of those connections have led to a model where firms like ours leverage market makers for order routing and use those firms to use their connections to get ours executed. That's the market structure that's evolved. It's working. There's competition in that space that's really benefited clients. The piece of the cost, which Allison just hit on, is the market data side. I think that we've got to be really, really conscious that market data costs are really, really high. I would say too high for retail clients. And as we look at evolving market structure, we've got to do it in a way that brings those costs down, whatever the form that takes.
Great. Thank you. Jim, sorry, we'll go to Jim and then we'll come back to you.
Yeah. Well, one cost that we don't talk about is the cost to the limit order that is allegedly traded through. And this is something where I really hope that the SEC staff uses its CAT data to tell us who is being traded through and are they being harmed at all. Yes, you may observe what looks like a trade through in the audit trail, but what happened to that order? If they waited a few more milliseconds, did they finally get filled after the alleged trade through? In that case, who's been harmed? And indeed, who are they? Are they someone representing Mr. and Mrs. 401k? Are they a retail investor? Are they an HFT? Who's being traded through? And are they really harmed in any way? Before we really make decisions, we should know whether there really is any cost to trade throughs.
Yes, Chris.
Thanks, Andre. So first off, I'd just like to say that I agree that Joe McCain is a rare individual, but I also agree with his viewpoint about if you repeal 611, you're not necessarily going to reduce the market data connectivity costs associated with it. I'm going to take a little bit different angle on the cost issue. So Many of you may not know, but over the course of the past decade, I read and summarize every single SRO filing, and I've done it for quite a while. Generally, there's over 1,200 of them a year. What makes this important is that's exactly where market data costs are filed and come from. All the market data costs and connectivity. So when I see things like an exchange filing for the 15th time as a new filing that was twice suspended by the SEC, basically usurping commission process, the problem isn't Rule 611. The unprecedented rise in these market data costs can be traced to two things. First, I feel the Commission's deeply flawed process for reviewing and approving many of the SRO filings, and fee filings in particular, is flawed. We petitioned the SEC, I think it's been 4 or 5 years ago now, to fix the process, and nothing's been done on that. Second, I think Section 916 of the Dodd-Frank Act, which was included at the insistence of Congressman Meeks of New York, essentially created a short-circuit expedited process that makes it procedurally difficult, if not impossible, for market participants to review and comment on filings on time, and for the agency staff to intervene the filings. So what we have is an evergreen state of filing. And if you read these things as long as I do, an exchange will file. When the time comes up, they withdraw and refile it, even if that filing's been suspended. What happens? Those port charges, those market data costs continue on. We're going on 4 years on some of these. Thank you.
Great, thank you.
Andrew,
Yes.
just one thing. Joe put out the data today, I'm guessing that's right. And I don't know exactly what's going into it, but just doing some quick calculation off of that 375 million, it does sound like a big number, but if you divide that by all the, just take that and divide that by all the equity shares that are traded in a year, it comes down to about half a mil a share. So I think, yes, we should continuously look at ways we can reduce costs, especially on the market data fee side. But we also need to put it in the context of the infrastructure that we all have in place and what it actually costs per share.
Okay, thank you. Thank you. I wanted to actually follow up on something that Jeff mentioned. You had mentioned that a lot of brokers use their market makers for connectivity and the like. Do you have any thoughts on how that impacts, how that plays out over the line in terms of spreads and execution quality?
Well, I think it does two things in my view. One is it allows us to leverage the technology investments of those firms. So when you go back to, and people are referencing, when co-locating became the thing, it let firms like ours focus on our core business, which was serving our clients, advising our clients, and not get into the technology arms race around it. We were able to leverage the investments that those firms had made. The second thing that market has done, though, it's inspired competition. We've now got a market now where exchanges compete with off-exchange venues for retail order flow. You've got a market where the market makers themselves compete for retail order flow. And if you just look at the statistics, you can look at execution quality, you can look at price improvement. I mean, all of those things have worked in the benefit of retail clients.
Got it. Thank you. Another type of complexity which came up on the first panel and you see in some of the literature around 611 relates to the proliferation of order types, complex order types. Hubert, can you kick us off on this? Do you have any thoughts on sort of what you're seeing and what it means for your firm?
Yeah, I mean, we definitely do see some new order types that are geared towards managing or handling Rule 611. A lot of those tend to be more of the ISO order types, the intermarket sweep orders that have been created so that people can kind of sweep through, through the book, knowing that they're taking out the protected quotes on other venues when they're sending orders to away venues. But I think a large degree of the hide not slide, price to comply order types that we've all kind of, talked about in the past are really not there to deal with Rule 611, but there to deal with other aspects of market structure. For instance, the ban on locked and cross markets. And so since you can't lock or cross a quotation, you oftentimes have to like change where you would have priced more aggressively, you have to slide that quote back so you can comply with the prohibition. And I also think part of the complexity also is allowing liquidity providers and market makers to make sure that they're on the right side of the quote, right? A lot of the order types are there to make sure that you're only adding and only providing liquidity so you can collect the rebate and capture spread, and so that you're not inadvertently crossing the spread when the order hits the exchange and the market like moves very quickly. So some of these order types wouldn't exactly go away with the elimination of Rule 611 unless you also deal with prohibition on locked and cross markets and other aspects of market structure.
Short sale, bid test, things like that. Yep. Yep. Is that Adam?
Yeah. And Huber makes a good point. And I do think that when you think about the lock cross prohibition combined with trade through, from an implementation and compliance standpoint, the difference is basically an equal sign as opposed to a greater than or equal sign. They're effectively the same rules. You can send an order at a price. So on a trade through, it's an IOC can go at a price. If you can't send a day order, if you have residual to post at that price, you're still impeding price discovery by not permitting that order to display. All the compliance systems are the same. All of the order routing positions are the same. And yeah, the order types you referenced are very much there for trade through to some degree, but a lot of it is on the lock cross side, or really the lock side of things. And I think that when you talk about order types, you send orders and those orders have features. And I think one of the things that adds a great deal of complexity is that you have features to do one thing sitting on top of features to do another thing. And the combinations of those can get quite extreme. But one of the things everyone has to deal with on every single order they're sending is it an ISO and the exchange can just kind of take the instructions and do it? Or if it's not, they want to accept that order and they want to handle that order in a compliant way for that firm. So that means, putting in like well-intentioned and thoughtful processes on like, okay, I have this order, it would lock the market. I want to work that order at the most aggressive price I can. That means I'm going to not display it at the working price that locks the market, display it at the most aggressive price that I can. Hubert noted, like, what if it's an ad liquidity only? And then you're dealing with what's the price on my exchange versus another, so they do get quite complex. Jeff kind of referenced, he gets to outsource that complexity to firms who do it. Perhaps where, we had a time in the early 2010s where there was a great deal of scrutiny on that, and it seemed like a lot of people realized that those existed. I think the better way to deal with it is to make things less complex. It kind of means the exchanges aren't changing prices and sliding things back and this and that. So, I think that things are complex. If we can remove one degree of complexity from the order types, it makes a big difference.
Got it. Thank you.
Just to add, I think speaking with again one of our desk heads, he said there's roughly 50 complex order types that we use, and to add to the discussion, I think we've hired these quantitative researchers to develop strategies to use those orders that would not be necessary without the rules in place. They could be that's an opportunity cost when we talk about the cost of complexity.
Those 50 rules are for a multitude of orders, not tied to a multitude of rules.
Right.
Not necessarily 611.
Exactly. Yeah. And to build on the point that 611 is not, considered in a vacuum.
Yep. Armando?
Yeah. The New York Stock Exchange should be commended for publishing the anatomy of the use of their order types. And if you go through it, if you count intersweep orders, intermarket sweep orders, ISOs, DNS orders, non-routable orders, it's roughly 54% based on August 2025 volume. That includes 37%, which was done in auction. If you remove that, that's the overwhelming majority of volume using order types that are meant to suppress or sidestep 611. There's been a lot of conversation here about locked markets. I just want to make one comment. Lock markets that are a stalemate over the rebate serve no function. They are confusing. They're nonsensical. A locked market should result in a very large trade. If it does not result in a very large trade, the market is not at equilibrium. The market is rarely at equilibrium. These are largely a function of rebate and waiting for it. And oftentimes they're the function of a slower exchange, not refreshing the non-display liquidity, and the faster exchange locking that market. So that should be something that's looked at, to the point that we reach nirvana where we can have a locked market that has endless liquidity. Of course, that would be great. That isn't what's occurring now when we have locked markets.
Thank you. Jonathan, did you have a comment? You good? Okay, great. One last question related to cost. And this, I'm curious as to whether or not folks can speak to the cost of complying with 611. I know on the prior panel, there were some remarks that it's actually kind of hard to quantify, but the rule is a policies and procedures based rule, but it still requires, surveillance, technology, exception reports. How are you dealing with this from a compliance perspective? What is your experience with the SEC examination and enforcement folks when they come in to look at your 611 compliance?
So I can't put a good number on it. I can kind of walk through how we think about it and just like the process. So, we have to build systems that are designed to comply on the front end. So that takes the rules complex and the implementation from a coding perspective is non-trivial. I'll touch on that a little bit at the end and with a different angle. We're now, like, when this rule was implemented, we were in a world of seconds and 30 seconds for, like the manual markets. We're now in a world where, the price precision is very fine. So practically, we have like FINRA or the SEC are likely looking at either the SIP or a consolidated, even direct market data feed. And for an active market maker, they will show us locking the market a lot. So the process around that is generally they see a bunch of locks, they may see some trade throughs, and they're going to sample those, send those samples to us, and we're going to show them, well, here's our view of the market. We have to have a system in place that has a quote snapshot every time we do anything so that we can tell them exactly which quotes we saw at that time. We give them our snapshot. Oh, these are the ISOs that we sent that satisfied some of the quotes that you show us either locking or trading through, to basically just demonstrate, here's what our system is, here's how our system works. That's a lot of back and forth that generally gets to, oh, okay, you're doing the right thing, and we move on. And I think we've seen instances where firms weren't doing the right thing and there was enforcement. So I do think that's a functional system, but that functional system has a lot of overhead associated with the exception reports, the systems that are built out to do that. I think the other aspect of it that does factor into the cost is if you want to be a firm that competes in the United States of America, you not only have to be good at trading, at customer service, at this, that, you also have to get that exactly right. And there's not a great deal of forbearance to come in and say, hey, I'm new here, so I'm going to trade through and knock across the market a bunch because I'm trying to figure it out. You need to get it exactly right from the start. And, we have seen, futures, firms that are successful in futures have a hard time getting into U.S. equities. We've seen foreign firms who are very successful in foreign markets have a hard time getting into U.S. equities. And over the long run, we tend to focus on like the one-off, two-off trade throughs. There's a bigger picture of competition. There's a bigger picture of innovation, and we don't know what we're like not allowing to happen, and the market forces that we're not allowing to come in.
Yeah. Thank you. Competition. So a lot of discussion in the adopting release for the rule and on our earlier panel about competition among markets versus competitions among orders and fragmentation and the like. I wanted to start out and sort of get your perspectives on fragmentation and in particular fragmentation, not just among exchanges, right? Not just the proliferation of exchanges. Please speak to that, but fragmentation between the lit market and the dark market, and get your perspectives on the extent to which 611 in particular has driven it. We start with Jonathan. You want to start us off here?
Sure. So I think when we think about competition, I will tell you, we've watched since we've launched, and since I've, as many of you know, been in this industry for a long time, we continue to see the amount of dark trading or off-exchange trading increase, and sitting at the exchange trying to figure out how do we get more flow and how do we innovate on the exchange to try to bring back more lit liquidity, or more liquidity on the exchange. And what happens is we come up with an idea and we try to take it to the commission. And so far, historically, it's been challenging to get that through, whether it's an explicit rule or an interpretation of a rule that prevents us from being able to do that on exchange. And so I think from our perspective, it's not 611 that has prevented that competition. So it doesn't mean that we're concerned. We are concerned about the competition. We just think addressing 611 is not going to change directly change that balance of competition between what an exchange can do or what can be done on exchange and what can be done off exchange. And that is a little bit of our concern. If we just changed 611, do we expect flow to move on exchange? And I don't think that's the case. So we would, as you'll hear, I continue to encourage that we have to look at other rules that are driving and forcing some of that flow off exchange. I'll also say that when you think about displayed, as I said at the outset, it's about displayed liquidity, trying to encourage displayed liquidity. I think the thought behind order protection is to encourage displayed liquidity. You can debate whether that's worked or not. If you remove that, we need to think about what else is going to encourage displayed liquidity, because I think the natural tendency for markets is to move to a bilateral setup. And so you'll see we have a lot of that off exchange today, and it provides great experience with people trading bilaterally on ATSs. But if we don't protect the lit quote, then what's going to happen to our NBBO or NPGO, however you want to call it. And so I think it's also thinking about how do we continue to foster a strong NBBO. And so allowing the exchanges to compete effectively, and then fostering that displayed liquidity is what we should be thinking about.
And I take it when you talk about competition, you're talking about innovation largely too, right? Being able to innovate more easily through the rule filing process.
Yeah, I think that.
Yeah,
of course. Yeah.
Armando?
My view is we're making too much between lit and dark. We already have markets that are overwhelmingly dark. Let's take the 50% that we generally credit for being lit. 15% of that 50 is at the open and the close between two exchanges. Exchanges do as much at midpoint hidden as all ATSs, or just a tick below. So they're virtually equal. And then if you factor in, which nobody knows, the percentage of volume that is occurring with an iceberg order, you're well over 50% of that 50%. The example that I would give you in terms of price discovery is the close. We generally view the close as very efficient. And take an example, we have 550,000 shares for sale. We have 500,000 to buy. We have 50,000 shares, the imbalance price, the 1,050,000 shares. So that's less than 5% that's contributing to price discovery, and the throughput is 1,050,000 shares. So I really think that we have to focus on this lit market versus dark market, and really focus to the point of view where, apply that quip, that one person's freedom fighter is another person's terrorist. One person's lit market is another person's slippage. And it is nonsensical, and it has been rejected, the notion that people are going to display a large amount of liquidity. So I really think that that's the key to strengthening the NBBO, is permitting and maybe even protecting uniquely the iceberg component of the order. Because I really view the issue with the market, as I said before, is the throughput. And there's too much focus on the lit component of it. And collectively as an industry, I think that we've missed the fact that we have tighter spreads, but the amount of liquidity that we have at those spreads are materially less than spreads have contracted. So the shape of liquidity has changed. It's much longer or wider, excuse me. It's less deep. And again, it's overwhelmingly impacted institutions.
Allison?
Yes, I would like to agree with that, that the NBBO quality is the specific issue of lit versus, is a better proxy than lit versus dark, because when you're trading institutional blocks, you're benefiting from that pricing concept of the NBBO, and that's really sort of where, we need that robust price discovery. I just want to bring up that we talk about fragmentation a lot in terms of number of venues, but there's also fragmentation in terms of time. So to the point of the close being sort of such a big event every day, at the same time we're all saying there's so many exchanges, there's so many venues, that's diluting the quality of the NBBO. There's also all these suggestions to increase hours and sort of spread things out over greater amounts of time, which I think is also a threat to the quality of the NBBO if we have to sort of spread out natural liquidity over longer periods of time. So I would agree that the right sort of focus is on shoring up the NBBO across time and space.
Sorry, please go ahead.
So, sorry. If I could add one thing, I think on the earlier panel, it was noted like 10% of volume was off exchange in 2004, 40% today. I think the 10% is wrong. So I think that like miscategorized NASDAQ volume as kind of on exchange. NASDAQ wasn't in exchange at the time, and the ACT volume was significant. The ECN volume was significant. My guess is it's probably closer to 30, 35 at the time. But be that as it may, if trade through is supposed to be the thing that protects displayed liquidity, it's not working. Right? Whatever that number was, I think it's higher now. So I don't think that that's kind of a rationale to preserve it. I think that one area that we could explore and should explore is if we want to reward displayed orders on markets that execute, we have a market data revenue sharing formula that currently just rewards those quotes. And we've seen massive distortions in, one exchange is 44% of the NBBO in SPY and 4% of the volume in SPY. So, volume that trades on exchange, I think is truly valuable. I do think that should be rewarded. And I think that's something that could just be an adjustment to the formula. But, I do think that we've seen a shift to non-display. Again, this isn't happening in a vacuum. There are other reasons outside of NMS for that. And perhaps it's in countervalence to that, but, it is the case.
Sorry, Kevin?
So first of all, I want to agree with Adam on the SIP reform. That would be awesome. We'll have that on New Year's Eve. Yeah, we'll have that one on New Year's Eve.
Just keep going, man.
I do. You're seeing a lot of me now, now that you're in this role. So I do want to bring home the data on exchange versus off exchange. So we looked at the on exchange trading without the crosses. And since 2020, there's been 2 years of growth in on exchange continuous trading. And where price formation and discovery occurs on the exchanges, that's how you know where things are trading. We've had 2 years of growth and it's up 16% since 2020. The off exchange is up 87% to 7.7 billion. So that is the problem. You need to reward price discovery. You need to reward that lit market. We keep saying the NBBO, but to me, it's really about price discovery. And you can do it by letting me compete, the exchanges, let Jonathan, let all of us compete on and off exchange. And that's the leadership I think we're going to get. And I am really optimistic, but that's what we support.
Great. Any other comments here before? I'm sorry, go ahead, Hubert.
Sorry, I just wanted to highlight, I definitely agree with the points that Jonathan was making. When you think about innovation that we've seen in the markets, the innovation that we're seeing in the markets are platforms like PureStream or One Chronos, Intelligent Cross, right? It's people coming to market with different order types, with the ability to kind of segment client flow, right? A lot of this is not driven by Rule 611. It's driven by other aspects of market structure, like fair access. But that said, like, I do think we have seen innovation in the exchange space as well. We're seeing new platforms like Texas come to market as a listings kind of venue. We've seen IEX come to market with a more innovative kind of speed bump type of approach to execution. So there is, innovation that's kind of happening, but I think we're getting too lost in the kind of displayed versus non-displayed. I think there's also sort of the question that was originally raised, which is how much fragmentation do we see in the exchange market, and does that make sense? I think when you look at the data that we saw earlier, there are 8 exchanges with less than 1% market share, and they cumulatively account for less than 3% of the market. And so we would suggest that there's something that needs to happen to address exchange fragmentation. But OPR isn't the only solution to that, or the trade-through prohibitions aren't the only solution. It is also things like how exchanges are collecting on-market data revenues from the SIP, or connectivity fees that they're charging to the industry. And so all these things need to be addressed holistically if you want to really address exchange proliferation and market fragmentation.
Thank you.
Can I just make one point on that? So I agree completely with what Hubert said. And I just add that, we have seen a lot of retail growth. I think the previous panel talked retail's now 30% on daily volumes, and retail sends their order flow to internalizers, and they're going to continue to send their flow to internalizers even if 611 is taken down. So the question is, if you want to get it on exchange, if you want control over that, then you need to think around rules around how that happens in the context of best execution.
So that's a perfect lead in, Chris. Thank you, to BestX. So it's interesting, we've had a number of comments that sort of, I guess, express the reality that 611 is BestX, and that's not the way it's teed up by the commission in its adopting release with respect to the rule, right? There's 611, and then there's BestX. There's explicit statements about how 611 is not meant to change your BestX obligation. So there's definitely a disconnect there. But I've heard a few times, both on this panel and the last panel, that if there are any changes to 611, they should only come after BestX is bolstered. So Chris, I know you've done a lot of thinking on this. I know you mentioned you've got a list of things that you think can be done. Maybe you can start us off on this topic.
Well, I'd say if you just want to wholeheartedly repeal 611, then make it easy. Throw a trade through on a trade confirmation. I mean, I get price improvement on my trade confirmations today. Why can't I get a trade through on my confirmation? And that goes with institutional investors as well too. I will say I did. After I left that trading firm, I consulted and I did a lot of work with institutional firms on implementing TCA in all kinds of different asset classes. And I was a little shocked at the lack of what was going on there. But what I really found is that when you look at a lot of the advisory shops that are out there, they're all trading through retail channels. They custody through one of the big brokerage firms out there. And when you ask those advisory shops, what are you guys doing for your TCA? Oh, well, gee, we just have a little check the box thing. They're not getting customized 605 reports. They're not getting customized 606. They're not really getting customized anything. And I think you got to think about things in that context, like how to get these advisory shops, which command a lot of assets and custody through these retail channels, the disclosure and information they need. And I think that's a really important aspect to consider.
Anyone else? Adam?
I guess as it relates to BestX, I do think we need to take another look at it. I don't know if the words in 5130 need to change, but I think the application of it does. I think that, there's been a lot of talk about how people won't disconnect from the exchanges, and they'd be afraid to disconnect from the exchanges. And on the earlier panel, they talked about the European approach to BestX, which is kind of more disclosure and policy and procedures based. So I do think in a world where you don't have 610, 611 effectively requiring everyone to connect everywhere, you just need a standard of, we did a diligent process. This is what we do. We disclose that to clients, and then we do it. And we reevaluate that as the market evolves, I think does come into play. One other thing that was mentioned as part of that was the how fees play into that. And I think we'll touch on access fees as part of this. Access fees was one of the big issues pre-NMS and pre-trade through rule in the NASDAQ market that didn't have one. So I don't think we can just say you get rid of trade through prohibition, access fees can go away. That was an issue and a market failure that we would need to think about. But the notion that we shouldn't think about that in the context of like trading and accessing markets seems wrong. Like if I told everyone to go on Amazon and find me the best price for a product, but don't include shipping and handling, guess what's going to happen to shipping and handling costs? So, and that's kind of the state that we're in. And I think that would have to be another part of the best X, kind of discussion to say, how do you think about that? How do they factor into your decision making? Otherwise, there's just no governor on what those fees can be. So, it is a big thing to look at. And I do think that, today, I think the backstop idea is not that 611 is best X. I think the idea is like, if you get an order and you diligently route it to a bunch of the best prices, you're unlikely to have a lot of criticism of that and say, why didn't you internalize that, right? Like that's not going to be a part of the discussion. If you internalized it, you'll have a lot of, why didn't you go to all those places? So, I think we just have to think about best X where you don't have that backstop of, if I did those things, I'm probably fine. But I think that's a really healthy discussion. I think that considering the explicit fees, considering the fixed fees should be part of that discussion to get to a place, ultimately those costs are passed through, whether it's explicitly or implicitly. So not having a governor on them is bad for the investors at the end of the day, and having them as part of the conversation and ensuring that we do a good job in that conversation, I think is a big deal.
Got it. Jeff, do you have thoughts?
Yeah, I was just going to say that, while 611 is obviously not best X, in the context of our best execution obligations and looking at our execution quality, I mean, the MBBO plays a role in that process. We are comparing executions against the NBBO. And so to the extent that we're looking at changing that, we're going to just have to make sure how that's going to translate into evaluation of retail best execution.
Jim?
And speaking of retail best X, as we've mentioned before, since the odd lots don't show up in the NBBO, measuring it against the NBBO really doesn't make sense. What we really ought to do is measure it against the actual displayed liquidity that is in the lit markets. That's how we should be measuring retail best X. It's easy to do now with computers.
So one of the questions I had, and maybe this is for Kevin, maybe for Matt, to the extent that we're thinking about, or the commission is thinking about eliminating 611 and relying heavily on best X in the equity space, you do have the standardized disclosures that were mentioned, 605 and the like. You don't have that in the option space. What would you think would have to happen in that space in order to eliminate the trade through rule in the option space?
Gee, thanks. First, he's got me coming in on Christmas. So I do think when we thought about this question, the very nature of the options market, given that it's all on exchange and the operation of Opera, if the trade through were to go away, it becomes more of a, the MBBOs derived from the market data and the prices there. So like, that's part of why we say that if the trade through rule were to go away in options, the market seems to be able to bear it. It just becomes part of the sort of consolidated tape in options, and that's something that we'd be pretty comfortable with, to be honest.
But how does a broker decide where to route among options exchanges?
Chris?
Yeah, please.
Can I jump in a little bit on here?
Yeah, absolutely.
I've got a few thoughts on this. So I chaired the SIPMA Options Committee way back, and options are a totally different animal. And comparing options to equities, as an old option friend told me, it's like comparing apples to oranges to Volkswagens. But the reality is, in the options world, we don't really have any disclosure. There's no 605 disclosure, and it's hard to just put a 605 disclosure in the options markets because you've got so many quoted classes for the underlying going on. Now, an interesting story with this is when I was chair, we set about creating disclosure for execution quality in the options markets. And my successor in 2008, Joanna Fields, saw it through, and there was 605 kind of like metrics in the options world, but it wasn't mandated. And because it wasn't mandated, nobody took it. And then it just quietly vanished, and it's gone. So I'd say, number one, if you're going to do something in the options world, right, and take out OPP, then you really should consider mandating disclosure and quality.
Got it. Thank you.
I'll
Yep.
chime in just because I passed the buck to Matt. But, and again, I keep quoting Chris, but Chris Isaacson brought it up. Like it's so complicated if you take it out of the option space with complex orders, because there's complex order auctions, there's price improvement auctions, there's the opening auction every morning, yet those 1.7 million strikes opened. And I think what you'll get is, and then we can add in the trading floors for even more auctions. But what you'll get is, I think, regulation sort of by punishment instead of by prevention. And I prefer by prevention, certainly where I can't see a problem we're trying to solve in options.
Got it. Got it. Hubert, do you have a?
Sorry, I just wanted to make one note on best execution and Rule 611, right? The common thought is if you eliminate Rule 611, that brokers' best execution obligations would prevent them from trading through better price quotations. And that I think that would be true for us and how we expect our brokers to behave. But Rule 611 also applies to all market centers, which it doesn't just include broker-dealers, but also includes exchanges and alternative trading systems. And so there is sort of this corner case that might exist if you eliminate Rule 611, that a market center gets an order, there's a better price quote on a different exchange, and then they don't route out. And that was something that we saw happening before Reg NMS was put into place.
So, sorry if I can, that could be a feature, right? Prior to NMS, there was a business of pricing blocks and trading them. And there was a robust discussion about, an exemption for institutions or institutionally sized orders. And something that we've seen in other markets globally are on-demand options that are more focused on, getting size than they are on what the NBBO is. So, what he said is true. And I think the discussion about innovation is there still is innovation, but it is happening within a framework that eliminates from even having the discussion about what some of those innovations look like. And then there are further areas of innovation, say along speed bumps, where there's a negative externality to market participants because if they have the right to have a protected quote, everyone in the market has an obligation to respect it. And coming from a place where the kind of driving force behind NMS was that we had slow exchanges in the ITS trade-through rule that were able to impede competitors and impede price discovery by leaning on that. There's a great deal of sensitivity to, delays and slower markets. Those kind of become non-discussions in a world where there isn't a trade-through rule because that negative externality on other exchanges and other market participants goes away. This was obviously an issue on IEX. We currently have 2 filings along those lines that are pending, that don't have to be controversial. If they comply with the Exchange Act, let them go. And a lot of the discussion goes away because they're not holding other exchanges, to their delay. And there's, I think, rightfully a great deal of sensitivity on that.
Interesting. Okay. Was there someone else who wanted to chime in on this?
I was just going to chime in regarding the options markets because I heard that it's maybe efficient. And I just say, is it operating efficiently? When you look at the payment for order flow rates in the options markets, they're considerably higher and a big source of revenue for a lot of the firms out there. So when you look at that aspect, there's a natural gravitation to want to push people into options because of how lucrative it is. And I would say that suggests that there might need to be more work around execution quality and disclosure in that marketplace.
Kevin, I assume you want to.
I've learned over the years that you pick your battles with Chris Nagy, so I'm not sure. I will say this, Chris, the only rebuttal I would have to that, I don't get into the payment for order flow space that much. I'm not as, no, but here's my question. Did you look at it notionally? Because if you think about the notional coverage of what the options market gives you, it might be a little, might put a different spin on it.
Yep. Okay,
That's a fair point, Kevin.
one, we're getting close to time. One last question. So we've talked about experiences in other markets. We've heard on the first panel about that. We heard the Canadian experience, which is useful. New markets, so digital assets, right? It's something that the commission is really focused on. NASDAQ has a proposal out to allow its members to trade tokenized securities on the exchange, and those tokens would comply with all the rules that would apply to any other stock that's traded on NASDAQ. But I wanted to ask this group, should the trade through rule have any applicability with respect to digital securities? I don't know if, Adam, you have any thoughts on that?
Sure. I guess like the notion that like Coinbase can't trade at a price because Gemini happens to be at that price, I think would be viewed as absurd in the digital asset and crypto universe. And I think that that's kind of worth the stock exchanges and stock market reflecting on. Whereas I think that there are a number of other aspects of the equities market and the regulated market that, you know, do warrant a lot of consideration. I think some of the fundamental things, AML, KYC, some of the transparency questions, perhaps execution quality questions, are like really fruitful discussion. But the notion that we're going to micromanage the execution, you know, seems a bit far-fetched. And I think especially given some of the aspects of that market, and those could evolve, you know, there's counterparty risk in that market. So, you know, your broker is that exchange. I might feel differently about one exchange versus another, and I might want to factor that into, perhaps I want to pay a slightly different price because I trust that counterparty more. So, you know, there are going to be differences in the market structures. You know, that's going to be an evolving space. But, you know, I think that there are some fundamental areas where we can look at, you know, where were there like significant issues that we can apply in the digital asset space? Where were there market failures? And where were there things that, you know, kind of things that were done on the transparency or public good side that, you know, could make that a better, more efficient market without getting into like, you can't do this because someone, you know, we know where I stand on that.
Okay. Jim?
When we talk about tokenizing assets, I just have to point out that we have been tokenizing assets for over 400 years in this industry. So the idea that we are tokenizing things is not really new. And when we think about, you know, how to deal with the regulatory aspects, what we really need to focus on is what are we tokenizing? What are the legal rights and obligations of the token holder? And we need to focus on the fundamental objectives of regulation, like fraud prevention, like making sure that the intermediaries are not going to, you know, take our money and run with it. You know, those are the fundamental objectives, and we can worry about micromanaging the details of trade execution farther down the line. But actually, if you liked this session today, next week, 1 week from today, here in Washington, will be Georgetown's Pissarro Center's Financial Markets Quality Conference. It's free. You can go to finpolicy.georgetown.edu. That's finpolicy.georgetown.edu to register. It's really great. Chair Atkins will be speaking. Fed Governor Michelle Bowman will be here. Goldman CEO will be here. We have a number of, I see people in the audience who are going to be here. So today, so don't forget, finpolicy.georgetown.edu. Thank you.
Is anyone surprised? Anyone at all?
All right. Well, welcome back, everyone. As you can see, Chairman Atkins has arrived, and so we'll hear from him now. Mr. Chairman.
Sure.
Is that on? Can you hear me? Okay, I guess sounds like it's on. So anyway, so thank you, Mr. Selway, and thank you very much for being here. I'm thrilled that you took on the task of being head of our trading and markets division. So bravo. We have a lot of work to do, and you're not doing it fast enough or, smart enough here. So we'll have to up the game. No, I'm joking. But anyway, he's doing a great job. So really happy and really nice to see you all here today. I'm glad to be with you to kick off now the afternoon portion of today's program. So before sharing a few reflections, I should point out, to make my compliance folks happy, that the views I express here today are my own and do not necessarily reflect those of the SEC in the past, perhaps in the future, and maybe not even in the present. So as an institution or my fellow commissioners. And of course, I should also like to thank each of our moderators, presenters, and panelists for lending their expertise to the task of examining items in our rule book that warrant a refresh. We've heard some thoughtful exchanges on Regulation NMS this morning, and in just a few moments, we will turn to our next panel on a subject near and dear to my heart. It's the trade-through prohibitions, which is a policy that I followed rather closely for several years, and one that I believe very clearly demands a course correction. As others have noted, the SEC adopted Reg NMS over 2 decades ago. Reg NMS consolidated the existing national market system rules under Section 11A of the Securities Exchange Act and imposed a series of new market structure reforms, including the trade-through rule, the access rule, the sub-penny rule, and market data rules. In short, Reg NMS gave the SEC an opening to substitute, indeed supplant, its own judgment for that of the marketplace. And today we're devoting this roundtable discussion to what I believe is by far the most problematic provision, and that's Rule 611, or the trade-through rule, whose deceptively benign name can do little to disguise the distortions that it's wrought over the years. For context, the Commission approved Reg NMS at the time of considerable transformation. Electronic trading systems continued to unsettle old assumptions about how markets could function as order handling and routing practices became more transparent. Intensifying competition, meanwhile, drove commissions lower, and penny pricing reshaped the mechanics of trading. Left to market forces, I truly believe that these trends would have steered the national market system toward an outcome far more favorable to what the trade-through rule than what the trade-through rule has delivered. Indeed, Congress rightly expressed in the Securities Act's amendments of 1975 that competition, not regulation, ought to guide the evolution of our markets. Regrettably, the Commission rebuffed that contention, and while the markets were still developing, the SEC decided how to fix them. Now, the stated purpose of the trade-through rule was to increase displayed depth and liquidity in the NMS and thereby reduce transaction costs for a wide spectrum of investors, particularly institutional investors that must trade in larger sizes, unquote. In practice, however, the rule restricted the price at which investors could trade by mandating execution at or within the national best bidder offer. This led the industry to treat price, unfortunately, as the only factor when considering best execution. If left to their own judgment, participants could favor one exchange over another due to speed, the likelihood of execution, or attributes of various other types or order types. I suspect the exchanges would have continued to innovate along many of these dimensions, but instead the trade-through rule reduced every consideration to one single characteristic, and that's price. To be sure, I've long and vigorously supported Regulation NMS's overarching goal of enhancing the efficiency of our markets. My differences have always concerned the means of achieving this objective. As the trading and market staff wrote in 2015, quote, "The SEC has often noted that one of the primary challenges in its oversight of the national market system is to facilitate an appropriately balanced market structure that promotes competition among markets while minimizing the potentially adverse effects of fragmentation," unquote. The fragmentation that has followed Reg NMS is now obvious to everybody. Unfortunately, the economic analysis in the original adopting release failed to grapple with these particular risks of fragmentation, its adverse impact on competition, or frankly, any costs beyond implementation. This was, I believe, a gross oversight that informed a myopic approach to regulation. To some of us who were here at the time, the short-sightedness was evident. My fellow commissioner, Cindy Glassman, and I spoke openly about where the commission could have avoided its missteps. In our dissent, we argued that it would have been better, quote, to improve access to quotations, enhance connectivity among markets and market participants, clarify the broker's duty of best execution, and reduce barriers to competition, unquote. The commission, however, chose to reject our arguments as well as concerns I thought thoughtfully articulated by many, many commentators. And that choice precipitated a highly fragmented market governed by rules that invite gamesmanship. Ironically, a rule intended to strengthen liquidity has instead splintered it among an unprecedented number of venues. The result is a marketplace with more trading platforms than ever, but fewer broker-dealers and traditional market makers to knit it all together. Those intermediaries have succumbed to a combination of increasing technology costs, exploding regulatory costs, more competition for a shrinking active trading clientele as passive investment vehicles have become more popular and flexible, among other issues that beset the industry. Much of this is great for investors, at least in the short term, but what does it mean for market health in the long term? We are now 20 years out from the troubled promulgation and implementation of Reg NMS. What will things look like in another 20 years if the status quo remain? Meanwhile, the fallout of the trade-through rule extends also to forcing institutional investors to exhaust the often limited amount of liquidity available at the NBBO before they can access larger pools necessary to execute substantial block trades, potentially revealing their intentions to a market eager to pounce on any information leakage. So none of these outcomes is a hallmark of the worthy goals of a fair, orderly, and efficient marketplace. So today, I'm quite pleased that the staff is engaging in a reassessment of NMS. I'm eager to hear the insights and perspectives that will emerge from our next two panels. Reg NMS has fundamentally reshaped our markets, and the Commission has layered 2 decades of rules upon its flawed foundation. So that's not to say that things cannot be improved. Many of the problems that we face today in the markets stem directly from the unintended consequences of regulatory policies. This sort of situation usually results when policymakers substitute their own judgment for that of the markets. As the staff reviews Reg NMS and develops recommendations, I've asked them to take a considered approach to avoid repeating the mistakes of 20 years ago. Regulations must evolve alongside the markets, and I'm committed to ensuring that a future commission is not going to be saddled with the same challenges that we've left ourselves 2 decades ago. So in light of these reflections, I thank you once again for your engagement and for your dedication to this critical dialogue. The work before us will help the SEC to fulfill goals set forth in its mission. So I look forward to the discussions to follow. I'm sorry I can't stay because I have to run across town, but I really look forward to following the recordings and the fallout and the commentary from what you all talk about. So that's great. So thank you. Anyway, thank you very much and good luck.
Thank you very much, Mr. Chairman. Can we please have the panelists for the third and final session to the stage, please? Okay, so for our third and final session, we will be moderated by Elad Roisman, also another former commissioner of the SEC and good friend of the building. Elad is a partner at Cravath, Swaine & Moore, where he's also a member of the Financial Institution Group and the Corporate Governance and Board Advisory Group. So Elad, please finish us off.
Thank you very much, Director Selway. Thank you, Chairman Atkins, for your remarks. Thank you, Commissioner Crenshaw and Commissioner Peirce as well. And thank you, Director Selway and your team for making this this roundtable a priority and for helping all of us. Just for everyone in the audience's benefit, what we're going to do is we will give sort of a 1-minute introduction from each panelist. Their bios are on the website and probably don't do justice to the level of talent and knowledge here. Afterwards, we will have 8 questions, and then we're saving the remainder of time for final thoughts. We are the looking forward panel, but it seems like that was also panel 1 and 2. So we have the benefit of that. And I think we can safely say we've heard of freedom fighters. We had an adorable kid. We had Christmas Eve. We saw a prop and a pretty impressive plug for an event next week. So
Don't forget the octopus.
And the octopus. So I think we can say safely that equity market structure roundtables are back. And so with that, why don't we start actually in reverse alphabetical order with Debbie.
I wasn't expecting that. I'm always last. Hi, my name is Debbie Tennis, and I am Global Head of Regulatory Affairs for JP Morgan's Commercial and Investment Bank. And first, I want to thank the Commission for having this important discussion and for the invitation to be a part of it. U.S. equities are widely recognized as the deepest and most liquid across the globe, as we've talked about on the prior 2 panels, a status that is underpinned by investor protection and efficient trading mechanisms. Retail investors now experience commission-free trading at or better than the observed price that they see in the market. Having said that, there are structural issues, as we've talked about on the last 2 panels, that we think merit attention. First is the proliferation of exchanges. We went from 7, as was referenced 20 years ago, to 16, which is going to 24, and we have to do something before that 24 goes to 100. I think perhaps having a minimum threshold of 1% for protected status might be beneficial there. I think also Citadel's recommendations on the revenue piece is worth looking at. Anything we can do to control that problem. Additionally, our large clients complain about 611 and their ability for block trades. I appreciated Chair Atkins' comments on that issue. And we actually think an exemption for large block trades here might make sense to allow them to get better overall execution. There have been good arguments on both sides of get rid of it or moderate it. I think it's clear, though, that it's provided market integrity and investor outcomes. And maybe selective refinements, we would support selective refinements, but we don't want them to result in disruptions to the market. As Joe McCain mentioned this morning, there are a lot of other rules that are interspersed with this rule. And my concern is that doing this is going to be complex, it's going to be resource intensive, and it's going to have short-term potential risks to the market depth and resilience. If we can't alter all of the affected rules simultaneously with removing this, if we were to remove it, I think we put our very healthy markets at risk. And finally, looking ahead, continued innovation in equity markets is both inevitable and desirable. It is imperative that reforms preserve the core protections that have made the U.S. markets the envy of the world as a global benchmark for efficiency and investor confidence.
Good afternoon. My name is Cameron Smith. I'm with the Texas Stock Exchange, and we've applied to be yet another exchange that apparently is not super popular here, but we aim to be a very competitive exchange, both in listings, which is a somewhat novel with the new exchanges, and also, of course, trading. And I almost forgot to thank Jamie and team for the invitation. We're not even an exchange yet, so I'm very flattered to be here to talk about market structure, something I've thought a lot about for the last 25 years. But instead of giving you a little bit of a commercial about the Texas Stock Exchange, I think it might be good, and you probably all have introduction fatigue at this point. So I thought I would just lay the scene here. We're in a market where mostly retail trades off exchange. Institutions, I've been out of the industry and I've started making the rounds, with the Texas Stock Exchange, so talking to the institutional sell side kind of firms. And when you talk to them, they'd say about 50% of their order flow is executed off exchange. And that number feels like it's going higher. And I guess overall, right, 53% is off exchange. In fact, I was interested to find that, and I'm sure most people in the room understand that the exchanges now seems like you try everywhere else, and then orders are going to the exchange. So there's sort of the NBBO is sort of a last resort price, is where we are in the history. And it made me joke to one of the guys in the meetings after he was telling me this. I said, I feel like I'm 7-Eleven selling milk. No one's going to come to me unless they've tried everywhere else first. And so exchanges are in a tough spot. Luckily, I think there's things we can do going forward to improve the situation, make exchanges more relevant, but more importantly, because this isn't about exchanges, it's bringing innovation to the equity markets, which needs it. There's a lot of competition from other asset classes, and we need to maintain the equity markets, both for issuers and investors. Thanks.
Good afternoon. Sorry, there you go. Good afternoon. Thank you to the commission for this opportunity, for Jamie and the staff and the other commissioners and the chair for enabling us to have this important discussion. We really appreciate the SEC's openness to revisit these rules and seek industry feedback with data-driven approach as to whether we want to change the trade through prohibitions and the many related rules. Our view is that if the problem is exchange proliferation, and that's really driven by the incentives that are in place in the market, which is the SIP revenue model, then I suggest we take a surgical approach to addressing the SIP issue, and then see if we still have that same problem. I think that when we look back at the predictions and concerns about Rule 611 that were expressed at the time of its adoption, they were correct, right? They've come to be, they've been realized. But as others have talked about, the market is efficient and it finds solutions. It finds efficient solutions to address these problems and the structural parameters that it's been given. Those solutions obviously don't come without a cost, but we know those costs, and competition helps reduce those costs. And I think it's important for us to take a very close look at what sort of costs, what's the range of costs and other factors, both in terms of changes in trust and confidence in the markets, investor confusion, and potential increase in costs if we make big changes to Rule 611.
Thank you, Jamie and the SEC for inviting me. My name is Joe Saluzzi. I am a partner and co-founder of Themis Trading. Themis Trading is a boutique institutional agency brokerage firm. We're based in Chatham, New Jersey. We've been doing this for quite some time. We started in 2002. Prior to that, I worked at Instinet for a while, so I know some about the electronic markets. But when we started the firm, we realized market structure was changing, and particularly in 2005, like the chair has said, with Reg NMS, and we knew we had to learn the inner workings of market structure for us to compete. We trade mostly small to mids and tough to trade stocks. So the bottom of the list of most institutional traders, we get it, and those are the ones that we really excel at, because you need to understand market structure in order to trade these stocks. You can't just pop them in an algo and expect to get the results. So they trade much differently. And I think it's a point that some of the other panelists made. It's much different than an ETF and a big cap versus a small and a mid cap. So I wanted to just read a quick quote from Chairman Atkins when he was before the 2021 Investor Advisory Committee, and he talked about Reg NMS. And I thought this quote was fantastic, and I could have put it in our book, Broken Markets, in 2012, but it was 9 years later. So he says here, Reg NMS is unnecessarily complex, invites gamesmanship, induces widespread market fragmentation, disperses liquidity, and diminishes transparency. Indeed, we have seen Reg NMS drive order flow away from exchanges, fuel unhealthy trading volatility, and expose the markets to flash crashes because its rules have led to the atomization of orders. And I think that word atomization is even more important than fragmentation, because that's what happens. Orders just explode, and they go to all different spots, off exchange, on exchange, hidden on exchange. So what happens, and let me finish the quote, sorry, and liquidity among a dizzying array of trading venues. None of these outcomes is a hallmark of the worthy goals of a fair and orderly and efficient market. 100% agree. I can't agree more than that statement. I just don't think 611 is the reason and the cause for all of that mess. And Professor Angel and I were talking before about the Rube Goldberg, if you've ever seen that diagram. And that's what our stock market is. It's a Rube Goldberg, right? We go from here to here, but we got to go through 17 different mazes to get there. So I'd like to talk, and later we'll talk about the reasons why on-exchange trading is so difficult, the reasons why we have atomization of orders, and what can we do to fix it. Thank you.
Good afternoon. My name is Mehmet Kanak. I run global equity trading for T. Rowe Price. To add to a list of things that you didn't think you'd ever hear, I'm actually glad to be back participating in another roundtable here at the SEC. Thank you to the SEC for putting this event together. It's been a while, but I think it's welcomed, and I know the industry collectively wants to get back at doing roundtables and having discussions about very important issues, and that's what OPR is. I have to give my standard disclaimer. I feel like Jamie, I had a displayed order out there. Jamie ran through it earlier, but I'm going to go ahead and reiterate it anyway. My comments today are going to be based on my experience as a trader for a large institution, but I want to be clear in saying that T. Rowe Price represents millions of individual investors. And oftentimes we represent a larger percentage of their savings through their pension plans, their retirement accounts, their mutual funds, and other products that are offered at T. Rowe. So while I'm up here advocating for market structure changes, I want to reiterate that those changes are to the direct benefit of those individual investors. We derive zero revenue from trading at T. Rowe Price. That being said, on OPR, here's the biggest displayed order ever. I don't like it. And I think everyone knows that if they've ever heard me speak. It's probably the one rule that I think has created more detriment to our markets than it has actually benefited. I do like analogies, and I thought Jim's analogy around the scaffolding was pretty appropriate. I do think that OPR was probably necessary, or some form of OPR was necessary in 2005 to try and get markets to connect with one another. But as others have pointed out, there's been a large evolution in our markets. And we've gone over the last 20 years from being very manual and slow to being extremely fast and automated. So I don't believe OPR is necessary anymore. And I'm happy to go into detail on that further.
I'm glad Jamie reversed the order so I could go after Matt and just say I agree with T. Rowe. And I appreciate BlackRock giving it one Kronos a shout out earlier. Thank you for hosting, for putting this together, for the opportunity. The U.S. capital markets are the envy of the world, and this roundtable is a great example of how the U.S. keeps further improving because it's taking in industry feedback, and we're really grateful for that. We also believe in regulation that allows both protection of investors, but also for innovation. 3 quick points on our side to kick this off. One would be price discovery. We learn a lot from different industries. One of the largest real-world successes of an auction example is actually the FCC wireless spectrum auction. It's important to note that OPR, or trade through prohibitions, don't exist. Had they existed, the auction wouldn't be possible. And so if you look at one of what is, many would say, one of the most successful auctions that continues to this day of those auctions, and you think about what is it that works there, it is something like 611 wouldn't allow it to survive. The person who has helped devise that won the Nobel Prize a few years ago. He's actually collaborating with one Kronos, which is really cool validation for us. So one was price discovery, 2 around mandated connectivity. One of the biggest reasons some brokers took longer to connect to one Kronos than they hoped was because they had to connect to a number of new exchanges. And consistently, brokers would tell us even though they know the data shows we are one of, if not the best venues for execution quality, they were sometimes delaying the connection because of complying with rules, not because they thought it was aiding their execution quality. Number 3, an arms race. Chair Atkins, also to quote from 2021, his quick line on NMS, he had, quote, "Firms are locked in a high-tech arms race for speed, directly attributable to provisions of NMS." And so on Kronos, we couldn't agree more. There is a latency arms race. We do think there's a lot of price time venues out there. We do think 611 is only exacerbating that. We hope for a market where things like smart markets can flourish. and innovation can allow further improved execution quality, and agree to the point of Matt earlier that while our institutional broker-dealer customers are trading on behalf of institutional money managers who are ultimately representing mom and pop, and so that is an important group of constituents. So we're excited to talk about things like block exemptions shortly. So markets changed dramatically in the last 20 years. So we're excited to be here. We're excited to reopen some of these rules and excited to take questions. Thank you all.
Thank you. Good afternoon, everyone. I also too want to thank the commission, Chairman Atkins, Director Selway, your staff, and everyone for taking the time to be here today. Thank you for the panelists before us to give us good ideas, as you noted, about how to move forward. I think I'll start by sharing a little bit about what I focus on at the New York Stock Exchange. So as Chief Product Officer, I look after all of our transactional businesses across equities and options, including the data business associated with that and our ETF listings business. I think, as has been said by a couple of folks on the panel already and panels prior to this, we all, I think, appreciate what the world looked like 20 years ago. And, we were certainly moving from, analog to digital, from manual to automated trading. And the world we live in today and some of the aspects that lead to the technological arms race that we're faced with couldn't have been imagined. And when you look at it that way and you think about what Rule 611 is meant to represent and how it plays into practice, it really is, it's a function of the choices that market participants can make, the agency they're given, right? Under the purview of Best X and what they're required to do in terms of seeing the NBBO as they need to see it and keeping record of it. Just think of the choices that can be made that make material difference in a world that makes decisions in microseconds. You have differences in data ingest, right? Is it software-based? Is it hardware-based? You have data transport. Is it wireless? Is it fiber? And then, lastly, you have this, as we were talking about on the earlier panels, the ISO exemption on top of that, which allows a market participant or a trading center to include its order flow in its view of what the protected NBBO is. And so what does that mean? It means trying to align the view of the NBBO is impossible. It's transient. It's subjective, right? And much of that is dictated by, in some cases, the laws of physics, but it's also dictated by choices that market participants can make about how important that real-time view is, right? Because we live in a world of such low latency that if you're trading on a much longer time horizon, people will make those choices, as we've heard from other panelists, to maybe use the SIP instead of direct feeds. Or if you're using direct feeds, you have all these different choices. So I think we need to keep that in mind, that it is a very difficult proposition. And when you think about what 611 was intended to do, where we've come as a market, it has just led to this excess of complexity, of fragmentation, both on and off exchange. Right? I think it's fair to point out, or at least ask the question, how many ATSs would there be in a world where, these anomalies around your view being different of someone else's view of the NBBO in very short durations didn't exist? A lot of that has to do with the quality of order flow and what people seek. And so I think as we talk about it today, keeping that in mind is really critical. And finally, like I will beat the drum of what we have in our markets isn't bad. It's actually really good. And a lot of that has to do with this simple fact that there's a price source that all of us are very inside baseball, right? We're talking about nuanced microstructure issues. But there's a price out there that anyone can see, that investors around the world can see, that they have trust in, that they have access to. And there's, I think, when we think about serving the public interest and what's in the true spirit of what we should all try to accomplish here, that's a really good thing. We should try to uphold that. It's hard as you think about unraveling 611 or changing it. How do we do that? But that's a really critical part of our markets that I think is helping this, through the last 20 years, even though some things have been suboptimal, look at the growth from investors and issuers around the world that want to be in our markets. And I think that that's a good thing. And we shouldn't lose sight of it. And just like Chair Atkins said, I am optimistic that, we can set this up for 20 plus years of exceptional growth going forward. So thank you.
Good afternoon, and thank you, Chair Atkins, Commissioners, Director Selway, and Commission staff for the opportunity to participate in today's important discussion on Rule 611 and trade through prohibitions. I'd also like to thank Alad for moderating this panel. My name is Daniel Gerhardstein, and I'm from Jump Trading Group, which is a research-driven trading firm with a significant presence in U.S. equity markets, global markets across various asset classes, and digital assets. Additionally, I'm here as Jump is an active member of the FI Principal Traders Group, which represents leading proprietary trading firms that are active in U.S. equity markets, and who recently published a position paper on targeted reforms to Reg NMS. We appreciate the Commission's commitment to reevaluating these foundational market structure rules, which have shaped our equity markets for nearly 2 decades. Advancements in technology, changing market dynamics, and evolving participant needs since 2005 present an important opportunity to modernize our regulatory framework. Thoughtful reforms can enhance market efficiency, reduce unnecessary costs, and deliver better outcomes for investors. And we look forward to the constructive and thoughtful dialogue today on ways that a targeted updates to Rule 611 can support the SEC's mission to promote fair, orderly, and efficient markets while upholding investor protections.
I'm Bob Colby from FINRA. I thank Jamie and his colleagues. I thank them for inviting me to this roundtable.
You're welcome.
Yeah. I'm here because with my colleagues, I interpret and apply the FINRA's best execution rule. And I should say I'm speaking directionally, but not formally for FINRA. That's my first disclaimer. Yeah, we also don't run a market. That's my second disclaimer. So I come to this roundtable not to praise the trade through rule, nor to bury it. Rather, I want to address best execution. Like everybody else that's been here, I want to address best execution because it is the fundamental and foremost principle of fair markets. And it's the structure that flows through the markets, and it's what all market structure rules should be designed to support. Best execution derives from agency and shingle theory. Is that for your shingle theory principles? It also is based in FINRA's best execution rule from the 1960s and also parallel SEC development of anti-fraud provisions to govern best execution. So it's really not true that the SEC doesn't have best execution rules. It does, and they've been very powerful in the last 4 decades. Best execution is a really powerful principle. And it can be and is enforced. I note that it's done through exams and it's done through disciplinary actions. But, it operates within the extant market structure. It doesn't create the market structure. It operates within the one that's set up. And the market structure can make best execution more or less simple to enforce. So best execution's application is simpler when it's supported by clear standards. What's a firm quote? What fees can be tacked on in addition to a firm quote? What costs can be imposed for access to a firm quote? What's the real tick size? So if you want to figure out who won the Boston Marathon, you got to make sure that they're both running the same course, that one doesn't go over Heartbreak Hill and the other goes on the flat or through the tee. And so that's what you need when you're trying to figure out best execution. Without clear standards, best execution will be applied either through staff interpretations or through exams and enforcement actions. The latter is not ideal. So if 611 and the supporting rules are changed or if they disappear, then the SEC and FINRA staff will need to collectively work on what interpretations are necessary to give substance to best execution. I'll stop at that.
Yeah, so Bob, in terms of praising burials, it is the Ides of September, I think.
Yes, it is.
I'd like to thank Chairman Atkins,
all the commissioners, Director Selway, and the SEC staff for convening this roundtable on such an important topic, and Elad as well. Thank you for moderating through this. I'm grateful for the invitation to participate on the third panel of the day, and grateful I've had the opportunity to listen to all these other panels and super knowledgeable input that we've received throughout this day. I am Matt Billings, VP of Brokerage and President of Robinhood Financial and Robinhood Securities. Those are the two FINRA registered broker dealers, so I know Bob pretty well.
Yep. We like each other.
Yes, we get along great, and we spend a lot of time with the colleagues, and we'll even compliment the FINRA Forward initiative and give a shout out for that. Robinhood, servicing the self-directed investing community, has over 26 million funded accounts. We are proud that our focus on a simple and innovative, our simple and innovative approach has brought millions of people to the markets who otherwise would not have been there. At Robinhood, we lead with a strong customer focus. This customer focus, coupled with a first principles thinking, has led to our innovative culture. Now, innovation and intelligent regulation can and should go hand in hand. It should go hand in hand, which is why we believe it is time to consider the rescission of Rule 611. We realize saying this is you just can't drop the mic on this. It needs a thoughtful, deliberate discussion around it, which is why we're here, and we'll continue to have more discussions about it, and there'll be a measured approach around it. But it is important that we foment the competition across our markets. And as Bob was saying about Reg Best X, we'll focus on that. But with everything Bob did say, it's also about the end client and the focus on them and making sure for all our obligations that all that we have to do and our regulatory obligations for this, it's also about our end client and the point of execution. So we look forward to digging into that. So thank you very much for having me. I look forward to discussion about our positions and why we believe this will ultimately result in positive outcomes for the retail investor. Thank you.
I'm Robert Battaglio from the University of Notre Dame. Thanks, Jamie, for the invitation. Jamie actually wrote 2 academic papers with me back in the 90s. Believe that. Anyway, he's got sites. Anyway, I wrote a comment letter with Bob Jennings on behalf of Fidelity back in 2000s, pointing out the flaws in the OEA, the Office of Economic Analysis study of trade-throughs. They use TAC data, which has latencies. We actually used proprietary data, had to match against TAC quotes, which still have latencies, and it showed that the numbers dropped dramatically, thereby saying, what's the problem? More recent research we've done is to show people route based on net prices, surprise, surprise, and don't need to be told to go get the best price. So thanks again for having me here.
Thank you, everyone. So let's go to the questions segment. This question's for Matt, Dan, Met, and Joe. We've heard a lot today about the effects of the trade-through prohibition on our markets and whether it's still necessary. How should Rule 611 be changed, if at all, and what impact do you think that would have?
Okay, great. Thank you. Certainly as several colleagues have talked about before, the U.S. equity markets have transformed. And today, the participation in our markets has never been more widespread. Trading costs have never been lower, and platforms and education have never been stronger. So it's an incredibly positive environment, but it can get better. It can get stronger, which is why we do support rescinding 611. In rescinding 611, the SEC can return to allowing competitive forces to shape our U.S. equity market structure as these unnecessary regulatory restrictions are removed. With the rescission of 611, let's let markets compete on price, improved technology, service, and the reduced costs will be a result on that. I know we had a lot of discussion regarding the costs in the subsequent panels, and I understand connectivity costs, market data costs. All that adds up to something, and all of that is something that we want to see back into ultimately the retail clients' pockets. We know that if 611 isn't there, and if it isn't, we don't have to, and if the fragmentation is reduced, then there's a reduction in those costs, which can ultimately make it back to the retail. We, Robinhood, doesn't necessarily. We do not get the costs directly. We get them indirectly via our market makers and wholesalers, but indirectly that does make us to us. Another thing we talked about was the complexity here. Rule 611 and excessive proliferation of exchanges, 8 to 16, over 1,000 order types, things of that nature. Robinhood does support innovation and competition in all parts of the marketplace. The proliferation of exchanges has neither spurred this innovation nor increased competition amongst the exchanges. as was noted earlier, there's lots of exchanges with de minimis market share. Doing away, fomenting this and doing away with rescission of this rule would probably lead to some natural selection and some reduction of the exchanges, therefore reducing the connectivity and the connectivity costs and the associated costs for market data. We recognize, while competition with wholesalers has benefited execution quality for retail customers, any costs due to 611 are dollars that could be repurposed for offering the better execution experience. So given the cost and complexity imposed on market participants and the downstream impact on retail investors, we believe it is worth questioning the rule's relative limited benefits and trying to justify the rule's continued existence.
Thank you, Matt. Daniel?
Thank you. So drawing upon our analysis and the collective experience of FIA PTG members, we also believe that Rule 611 should be repealed and replaced with a modernized, principles-based best execution framework as outlined in the position paper submitted this week by PTG. The current trade-through prohibitions, while well-intentioned when they were adopted 20 years ago, has resulted in significant unintended consequences. The rule has led to a one-size-fits-all approach to best execution that does not adequately address the diverse requirements of different investors and market participants. As highlighted in the position paper, 611's narrow emphasis on displayed price fails to assure the best outcome for investors when considering factors like order size, liquidity, speed of execution, and all-in transaction costs, including fixed transaction costs. We propose the repeal of Rule 611 be accompanied by enhanced FINRA best execution requirements, which would require that broker-dealers publicly disclose to and adhere to routing policies and procedures. This framework would empower market participants to make informed decisions while maintaining broker-dealer accountability. These new best execution disclosures deliver required transparency, offering detailed data on price improvement, size improvement, and execution quality metrics. This set of reforms, we believe, would produce several important benefits. Overall, and this has been mentioned a lot today, reduce complexity. By limiting the need for industry participants and exchanges to operate and maintain elaborate systems solely for trade through compliance. Lower costs, as market participants would not be forced to connect to every protected venue regardless of value. Per our own internal analysis, the fixed costs of connecting to U.S. equities exchanges are 350% greater than the average of the top 10 markets we trade globally. And most importantly, improved execution quality as brokers could focus on achieving the best overall outcome for their clients. Together, these enhancements would promote innovation and competition based on execution quality and other factors rather than regulatory compliance.
So I think I heard from the previous panel that Schwab was supportive of rescinding, and I just heard Matt Billing say it. It almost kind of took me off my seat. And I heard some market makers also kind of reiterate the same opinion, and I'm here saying it, so I think we should just end it here and rescind the rule and move on. So why I don't like or never really liked OPR. So there's four reasons why OPR was put into existence and kind of what it's caused in our marketplace over the last 20 years. So I think a lot of the previous panels have already highlighted displayed liquidity did not improve. So the first assertion of, putting in OPR to try and encourage displayed liquidity, that didn't work. That's fine. Trade-throughs. Trade-throughs were a significant thing, probably back in 2005. Armando highlighted that pretty well. Trade-throughs don't really exist now. I know what the SEC put together earlier and some data around kind of the rate of trade-throughs. But if you think about what a trade-through is with our automated and super efficient markets that we have, if a stock's about to be traded through and the quote's going to change, I guarantee you someone's going to pick that off. And that's why they should do some work around what actually happens. I think you made that point, Jim. What actually happens to that quote that gets traded through? Does it trade microseconds later? And if so, is that really a trade through? Like, who got harmed? I would argue, by the way, as an institution, if you want to trade through my order, that's great. Reprice me lower. I'll buy it at a better price than I would have if you had picked me off. So trade throughs, I don't know. I don't really get that. And by the way, that's on the posting side. On the taking side of things, best execution standards dictate how you take liquidity. So this notion that, all of a sudden we get rid of OPR and people are taking liquidity all over the place at different prices, that's great, except they have to report that in 605. We monitor that from our broker performance. If we're noticing significant dislocations in prices relative to where the prevailing NBBO is, we're going to ask questions. And I would encourage retail participants to do the same thing. So I don't believe trade through is a significant enough reason to keep OPR intact. What OPR has done that I think is detrimental is fragmentation, right? We have way more exchanges, and exchanges are frankly subsidized by the order protection rule. And we're going to continue to have more exchanges. So if we do nothing with OPR, if we're here, I won't be here in 10 years, but if you guys are here in 10 years discussing OPR again, we might be looking at 30, 35 plus exchanges because there's no reason why you wouldn't keep launching them. I think, and by the way, I'm not naive enough to assume that if we were to rescind OPR tomorrow, that everything would change drastically the next day. It's going to take time. But if OPR doesn't exist, over time, those exchanges that were highlighted earlier having collectively less than 3%, there won't be as much of an incentive to direct orders to either post there or to take liquidity from them. And so you should see some attrition over time. It's certainly, I can say confidently, I don't think will lead to 35 new exchanges being available in 10 plus years. And the last piece is best X. So best execution from a self-directed individual, I don't think can get much better than it currently is. We'll say from our perspective as an institution, OPR puts restrictions on best X. And Chair Atkins actually pointed it out. I wish I could have just taken his comments and reiterated them. But it does put a restriction because price becomes that stopgap. And I can't go to my broker dealers and say, go ahead and ignore that quote and go somewhere else. Or, you know, if a market maker on this panel or on the previous panel wants to kind of make comments around delays and not liking delays, well, guess what? Without OPR, you don't have to go to those venues. Those venues no longer have to be in your routing table. They're not protected. It gives you the choice to choose where you want to go and where you want to execute orders. So from my perspective, we get the benefits of having a more robust, probably a principles-based execution, best execution for institutions that allows us to differentiate. If you actually look at all the participants here, whether they're self-directed individuals, whether it's a large asset manager, you know, anyone that's trading for a small asset manager, small cap liquidity, whatever it might be, the differentiation best X doesn't exist. We're all based on best price. That's literally the case. There is no differentiation between how my orders are handled versus how a self-directed order is handled at the larger level, because you can't take my parent order, which has 1 million shares, and trade it any differently than achieving the best price on the screen, because you would violate OPR. And so getting rid of OPR allows us that flexibility to diverge, so I can compete with Hubert in different ways, so I can compete with other asset managers in different ways. And so I look at the benefits of rescinding OPR, and I don't really see any negative impacts. Now, there are some things that have to be refined. The most important thing is that the SIP or some form of the MBBO has to exist. And so right now, the one benefit, I guess, of OPR is that it's clear, right? If you're a protected market, you are part of the SIP, and therefore you get to participate in price discovery, and your quote is visible. We have to determine how that SIP is derived in the future if there is no OPR. Which markets get to contribute to it, what quotes are visible, and what is kind of determined to be NBBO and pretty good BO. So that's what I would say.
I'm actually really surprised at some of the comments over there. I understand why Daniel, as a proprietary trader and a member of FIAPTG, would want to get rid of it, because it gives them maximum flexibility. You can trade as a prop trader any way you want. You don't have to have OPR anymore. You've now been, you know, it's off, right? Everything it's great. So I understand that. But from a retail broker's perspective, I'd be a little concerned if I was posting a bid on a broker. Let's just say the spread is 5 cents, you know, nickel bid offered at 10 cents, widespread stock that I trade. And somebody comes in and posts an 8-cent bid through a retail broker that has to be displayed, a limit order, right? Most likely a market maker will post it on one of the exchanges, or maybe it'll get directed there. If that retail broker's trade or order gets traded through, what does that do for the confidence of the investor who placed the bid to tighten the spread? A spread that, by the way, all the off exchange guys are trading off of. So I'm be very concerned about that. My opinion, again, is I think OPR is not responsible for the fragmentation and everything. I would limit it. I would limit the amount of exchanges we have. And obviously, I like the threshold experiment that they did in Canada. I think that even though I know market data was the other reason why, I think that's the right answer. But now let's think about this for a second. Why do all the exchanges complain that all the business is going off exchange? Why is everybody saying, oh, there's too much business off exchange? I could tell you, our order flow, outside of the opening and the close, 90% is traded not on lit venues. In other words, we'll be on exchanges, but I'm not lighting up, and we'll be on dark pools. And the reason why I'm not going to an exchange is because it's toxic. Everybody could see it. It's information leakage, and you can, proprietary data feeds, folks, if you know what they are, they record everything you do. Every time you're revision, every time you cancellation. These are order by order proprietary data feeds that leak information. I'm not going to an exchange that leaks my information. I need to protect my clients. I feel much more comfortable sitting in the dark, whether it's on an exchange. My preferred exchange is IEX. I've been telling people that for years. We spent a ton of volume on IEX. And people say, how could you trade so much volume on IEX at only 2 or 3%? Because it's good flow. And if you know what you're doing and you have some patience, instead of spinning around the wheel of the algo wheel, you can get stock done there. But the point is, why do institutions want to go off exchange? Why do I want to go off exchange? Because it's toxic. So they need to figure it out. The exchanges can't just say, hey, it's OPR, that's why we can't compete. That's not the reason, folks. The reason why exchanges can't compete is because they try to become like brokers. They're trying to put order, order types and do all these other things. But in fact, they're SROs. So, you can't be both. You are what you are. When you're a broker, you want to be an SRO. What do you want to be? Armando Diaz and his firm is being very successful because institutions are finding new ways to trade. That was an innovative approach that Armando took with PureStream, and people like it. It's a way of creating liquidity, right? It's unique liquidity. It's not the same liquidity that's spinning around 17 different exchanges, 16 different exchanges, and 30 some odd dark pools. So that's innovation, right? So, how do you get it all back? Again, I don't think the answer is to get rid of OPR. I think OPR, obviously we all have best execution responsibilities and that overrides everything. But OPR is a way of keeping that intact. It's kind of like checking things, making sure you don't go out of control. And it keeps FINRA's job a little bit better. Maybe don't have to analyze everybody so much. But OPR is important. You can get rid of 8 exchanges, but by just doing the 2% threshold, we can get rid of a bunch. So that's where I would go with it.
No shortage of strong feelings. So following up, what benefits to the markets do you think would occur if Rule 611 is modified or rescinded? And let's start with you again, Matt.
Yeah, first of all, I'll address Joe's question regarding, if you have a retail bid that comes in between the tight and the spread, and you kind of asked and answered it in a way that talks about the best execution obligations with that. Those are not going away. Okay, so we're contending that if we invite this competition with best execution obligations and maybe even clarifying those even more, that retail order flow, that limit order flow is as likely to get filled today as it is tomorrow. There is a component of that may result from it not getting filled, but we contend that the addition of the competition is worth it in regards to the best execution being the ultimate obligation here with that. So thank you for that. So certainly the U.S. markets have transformed, as you mentioned. Most Americans could not afford to participate. So with rescission of 611, the resulting reduction in complexity and costs and the interplay of competitive forces on exchanges are incremental steps into a financial system that works even better for everyone. We believe that reducing exchange fragmentation would benefit our markets and investors as exchange costs indirectly factor into the execution costs. Every dollar that is unnecessarily spent in compliance with this rule is a dollar that may otherwise be used to provide a better investing experience for a retail customer. Leading into the best execution rule 5310, as it reads out, broker-dealers use reasonable diligence, ascertain the best market for security such that the price of the customer receives is as favorable as possible under the prevailing market conditions. We're going to focus on prevailing market conditions. FINRA Rule 5310 has proven to be a thoughtful, resilient, principles-based rule. It has stood the test of time, and when needed, they provided some clarification through reg notices 1546, 2112, just to name a couple. Important to note that one of the more significant rules in the last several years, the Market Data Infrastructure Rule, that brought about significant changes to our market data complex, competing consolidators, things of that nature, did not contemplate any changes to 5310. In other words, it said, realize what's happening and take in consideration the prevailing market conditions. Do not stand still, change with it. Change your processes, change your approach, change whatever it is that you're doing to make sure that you're fulfilling your regulatory obligations and benefiting your client's experience. Even with the sweeping market structure proposals that were released in 2022, by and large, albeit for the Reg Best X, 5310 was left in place because everyone kind of realizes that this is such a intelligent principles-based approach that it just kind of stood the test of time. And with Reg Best X, large majority of the industry comments were pointing to the fact that 5310 exists today and doesn't need to have any more complexity to the marketplace. So is it worth clarifying 5310 in light of this significant move that we're contemplating with 611? Of course it is. We need to get together and think about what the changes would be, see whatever it is that needs the point of clarifications with that. But ultimately, it's stood the test of time and will continue to serve its purpose as a principles-based approach. And ultimately, it's just up to us to service our customers and give them that price that they deserve under whatever the prevailing market conditions are.
What?
Thank you. Three main benefits we see, and we'll unpack them, but it would be improved execution quality, added innovation, and reduced burden. So hopefully those things all sound pretty good. Just to unpack a bit more. So One Kronos operates a U.S. equity ATS. Many brokers say is leading execution quality. In fact, literally during the roundtable, a major bank I see in my email just said they have refreshed their stats and we're #1 according to their data. So hopefully they sent it to all the buy side. I think One Kronos, I bring it up is because it is a proof point that you don't need to be a connected venue to flourish. Newcomers can survive and can thrive. And so that is, I think, a big reason why we bring that up. Also, again, want to note the trade through prohibition aspect, this aspect of 611, it is causing infrastructure costs to balloon. And so it is something that we want to keep emphasizing. Market data is a big problem. We do see that is continuing to grow. We do hear that from the major institutional brokers we work with and their buy-side customers. And we do see the fact that our customers are telling us there's a total disconnect between the venue's available liquidity / the quality of the liquidity of a venue versus the cost that they are incurring for the venue. And so that disconnect doesn't make any sense. Minimum market share thresholds, again, we see as a really practical way to borrow lessons learned from other countries, other asset classes. And it's worth noting, because we spoke with a lot of the folks that we get to work with, it's not just about something like 1 or 2% market share. It's about 1 or 2% of displayed market share, because otherwise you might as well make hidden venues protected as well. If you're not going to distinguish, you might as well make hidden benefits, give them liability caps if you're not going to keep if you're going to blur the lines. And so we do think, when you think about even things like the SIP revenue, the balance of the quote versus the trade revenue that Joe McCain mentioned earlier, I think there's a lot of merit to revisiting that and rewarding the trades on more so. And when we talk about the fact that about half the exchanges today would fall out of the threshold, would fall below the threshold we're describing, we see that as a potential for cutting infrastructure costs or connectivity costs, potentially in half, is one potentially dramatic, but one way to look at those numbers. And when you think about the fact that 16 will soon become closer to 24 U.S. equity exchanges, let alone options, those numbers get much higher. And so we do see a lot of benefits across the board to reduce costs for customers, and ultimately the end investor is going to benefit. All of these things will benefit the end investor significantly.
Thank you. Matt?
I have answered this question already before, but one, if you don't mind, I want to talk about thresholds. So thresholds are great at addressing the issue around fragmentation. So we would have 8 less exchanges that are protected, but they could lead to a lot of gamesmanship. Obviously, if we put a 1% rule in, someone could juice up their market with certain pricing incentives to exceed the 1%, be protected, and then allow their market to fall below that by changing their pricing structure. You still have to go there. So, now we're stuck to whatever the regulatory regime has decided is the appropriate time frame of reviewing whether or not the 1% threshold makes you protected or not protected. It also leads to a lot of confusion, right? Like we sitting there and saying, well, we can't disconnect from folks because they could exceed 1%. When they do, we have to connect to them, and then we don't, and then we do, back and forth. So it doesn't reduce the cost burden that Vlad was just referring to. So I'm not a big fan of thresholds. Now, I will just go back to some of the benefits. I do think you're going to see less exchanges, or the incentive for new exchanges decline significantly if we don't have OPR. It would address the existing one-size-fits-all best execution regime that we have. So I think that's beneficial. And then going to the exchange level, it would allow them to innovate. If you're not protected, the question to the SEC would be, do they still have to abide by fair access standards, or can they, experiment with different books that they have and offer segmentation or offer different ways of interacting? I know it would allow institutions like us to actually innovate and price outside of the NBBO for larger orders. And there's always been a need or an ask from some of the HES providers to say, what if I priced you a nickel up? Well, you can't. But if you could, and you can run an auction if we didn't have an existing OPR regime. So I do think it leads to a lot more innovation, not only on the lit, but also on the dark space. I think those are the benefits that we would see.
Thanks, Matt. Andrew?
Thanks. We're all for doing a holistic review of Rule 611. We think that's a good thing. But making changes like rescinding or scaling back Rule 611 due to reasons like cost saves, reduced fragmentation, or increasing competition or innovation aren't good reasons in our view. If you look at the cost save argument, it's that there'll be fewer exchanges you have to connect to. Well, as folks pointed out, if we snapped our fingers and half the exchanges or all of them weren't protected tomorrow, I don't think any broker would save any money, because they're not going to disconnect from venues that they're used to going to. They're already connected to them. They're in their execution algorithms. They're in their routing wheels. And their best execution tools, especially as an agent, it's hard to justify not connecting to a venue without being at a competitive disadvantage to other agents in the market. The agency model really doesn't, because, when you think of, well, let's let market forces determine which venues survive. Let's get rid of, Rule 611 and just let the market decide which ones are there. That works in a principal-only market, but when you have agents in that market too, there's competitive forces between the agents that force them to connect to and have more items on their shelf, if you will, be connected to more venues than they otherwise would if they were just from a principal perspective. We also think that the cost could go up quite a bit in terms of, if exchanges are no longer protected, they could charge higher amounts for market data. There's less grounds for Rule 610 on limiting, what they can charge. If these unprotected exchanges can connect to the SIP, well, then they're still going to get revenue share, and that's the reason they're coming now. So how does that change anything? We need to change the incentives to change the problem. Other factors are, the NBBO integrity, having a universal benchmark for all retail and institutional investors, to point to, kind of like a true north. Because we have a defined north on our compass, it makes it easier for all of us to know what that standard is, and we can look at a common benchmark. Having a partial protection or no more Rule 611 could create a lot of confusion for a retail investor who has 2 mobile trading apps, and they're seeing different NBBOs in each of these apps. The natural conclusion of that clearly is that the market's rigged against you, and there's some greater conspiracy out there, which we don't need more fuel for those fires. Exchange competition, to the points about innovation, like has been mentioned with PureStream and Armando and other ATSs that have innovated. There isn't anything preventing ATSs from innovating right now and doing their unique segmentation mechanisms or speed bumps or batch auctions, and exchanges can innovate in other ways. But when it comes to kind of creating this quote unquote fair playing field or, level playing field, I think it's important for us to step back and realize these are different divisions, different leagues of the same sport. And these are business decisions to be in different leagues here. If you choose to be an exchange, you have certain responsibilities and benefits, whether that includes Rule 611 order protection or not in the future. I don't think that is as relevant as the benefits of basically free clearing through the NSCC, DTCC, SIP revenue, exchange immunity. There's a few more there that I'm not remembering right now, but as an ATS, you have higher costs and lower barriers and more flexibility, but that's a business decision. But like I said, exchange proliferation is the problem, and it's driven by SIP revenue. And I think addressing the SIP revenue issue is more important than just breaking the compass, if you will, so nobody knows where north is.
Thanks. The next question has actually been answered by everybody, but you guys, it's now your turn. Understanding that Rule 611 is woven into our markets and rules, what other requirements would need to be or should be changed if 611 is modified or rescinded? And this one goes to Bob, Vlad, and to Cam. Bob, why don't you start us off?
Well, I don't have a lot to say here. They don't, and none of them have to be changed. They could all stand as they are. The rationale for them from a protected quote basis doesn't persist anymore, but you do have to have standards, right? Unless you're going to just let every broker decide for themselves whether they ignore a trivial cost and thus skip a market.
Yeah, so 3 buckets, best X, block exemption, and Reg SCI would be the 3 comments. So Chair Atkins in 2005, and actually just literally about 30 minutes ago, talked about the fact that price gets too much focus. Things like quality of fill should get more of a focus. And so that's the pro and con that 611 has brought to the industry. And so it is worth thinking more about that. Institutions think much more about the quality of fill rather than the price itself. And there's a lot of merit to that. It is worth noting, part of the comments, just so I can stay on the theme of always agreeing with Matt. So the reason why many brokers would say they wouldn't disconnect from venues they're already connecting to, brokers do that all the time with ATSs. The bank I mentioned earlier that said one Cronus number one, in that same note, they anonymously said they disconnected from an ATS. That happens all the time with ATSs today, if they're not fulfilling some unique duty. That never happens with exchanges, so it would start happening over time. And so that would make a big difference. But one of the things that happens, and one of the things that I think a lot of people maybe are too polite to say on the panel, is there is a fear that if you disconnect, and this is no offense to Bob, just because you're on the panel for the sake of discussion, that somebody will come after you and say, hey, why did you disconnect? Go prove it to me. And so whether it's a safe harbor or some other language needs to be put out so that brokers don't have this fear down the road of retaliation because they're no longer forced to connect to some exchanges and they've chosen to disconnect. And so there is something to be said for ensuring that there's some level of that protection so that brokers actually do start disconnecting if they think it is not aiding in execution quality. On the best X side, it would be beneficial for the execution outcomes for price discovery to remove just constantly being bound by the MBBO. We trade over 1,000 blocks per day. We see a lot of merit for true price discovery. We talked about the FCC wireless spectrum earlier, auctions earlier. The block exemption could be revisited. Maybe it's not the exact definition today of a block. I think that's worth further thought on what are the right metrics, but the idea of a block exemption would make a lot of sense. And lastly, on the Reg SCI front, there are venues right now that artificially stay below 1% of the market just to try to avoid compliance with a pretty significant burden. There isn't any commensurate benefit with that burden, and it almost treats off-exchange venues like an exchange in terms of all of the burden, none of the benefit. It's very lopsided. And so it's almost treating these ATS as if they are part of the national infrastructure, but giving them none of the other commensurate benefits. So just streamlining SCI makes a lot of sense in general, and we see that ultimately allowing for more innovation, ultimately reducing costs for investors, ultimately aiding in capital formation. So those three items around best ex, block exemption, SCI are things that we would shortlist. Thank you.
So much to comment on, so little time. My memory's not that good to go back and hit some stuff, but I do want to say we're registering to be a new exchange. The premise of the business is definitely not that there's an OPR and that you have to come to us. We intend to earn the business by having orders displayed on our market that are attractive enough to hit. I think, market participants, if anything, are economically rational. If we're there at the best price, I don't think you necessarily need a rule there in order for them to want to hit it. As long as our trading system is world-class and the prices are right, I think they're going to hit it. So it's definitely not the business plan of the Texas Stock Exchange to, we need this OPR. We're fine with it being removed. We haven't touched on lock and cross. I'd love to get to that, but you asked me a question about what other, well, lock and cross, but I would rather talk about the fair access because I set up with that with my introduction, talking about why, exchanges are last. Joe called exchanges toxic. But let's think about what that means, throwing around labels, but exchanges aren't, we don't give executions, right? Like it's a technology, it's a bulletin board where people can post bids and offers. So they're not determining the price. But why, so what does it mean that it's toxic? Everyone's very mark-out sensitive after being out and coming back and seeing how the market's changed. That's the biggest change I see. Everyone's measuring, well, what did the market move against me 500 milliseconds later, 200 milliseconds later? And that sensitivity has everyone trying to avoid exchanges. Why do you avoid exchanges? Because they have a posted bid and ask, right? It's visible. It's the MBBO, right? But having been also at a high frequency trading firm, I can tell you the little secret that one of the number one indicators in any model, it's not tides on the moon or something complicated. It's the bid and the ask. And when they decrement, that's a major signal. So when you post an order on exchange and it's posting an MBO, it's providing a public service and that order trades, that is a huge indicator and therefore the market will move. So the exchange is on one hand providing a public service. On the other hand, you're going to have, your markup's not going to look as good as if you went into the dark in a segmented ATS and traded with a very cherry-picked counterparty who, after they trade with you, isn't going to run around and update their quote on every other exchange. So there's completely different dynamics. And these are important because I think when you asked me, there was a question, this isn't just a speech, about what would you change? It's the fair access. And I think actually fair access gets to fragmentation and everything else too. And here's how. So you have exchanges with multiple medallions. Why do they have multiple medallions? Because you kind of only can have one business model in an exchange. And if you have another good idea, then you need another medallion to spin it up. And the ATS can sort of like have, it could be multiple markets simultaneously. You could have a waterfall effectively. Your order comes in, you can interact with the quoted market. Maybe we can do something inside. We got different, it's as if an exchange can only sell vanilla ice cream. And then if somebody comes in and says, I want chocolate, I got to send them to, across the street. But that just kind of makes no sense when you think, what is an exchange? It's a central meeting place. And yet exchanges are very pigeonholed in part because of OPR and other interpretations of fair access. They can pretty much only provide a very relatively simple service, putting IEX aside, and that's a whole topic we don't have time for. But I lost my train of thought. So where was it?
Ice cream.
Oh, the ice cream. The ice cream analogy is, so we need to be able to, if you come into an exchange, if we can provide a multitude of different execution possibilities in one place, then you don't have to route all over the street. So in a sense that the proliferation of venues is exaggerated because no one exchange can provide enough service because of the fair access. So I think one reform we should consider is some sort of rule where, exchanges can also operate ATSs. And maybe we have only kind of two kind of quotes in the world. The fair access, readily accessible SIP quote, and then everyone else who's, segmenting and doing whatever. Those fair access, immediately accessible quotes, they should get most, if not all, the market data revenue, because the MBBO is the bedrock of all, people have midpoint orders. What's it based on? The MBBO, best execution, MBBO. They need to get the market data. If you put up a quote, it trades, especially. That's the most valuable thing. And then to the extent that exchanges also want to simultaneously offer hidden books, hidden orders, I don't think that should get much market data, but that's a great service because, again, people are managing markouts. Institutions are trying to accumulate or sell stock, and they don't want to do it and see the price move. So, of course, they're trying to avoid, trading on lit markets until the very end. And so why can't exchanges service that? I can keep going, but I'll stop there.
I think that's pretty
It's
good.
very hard to solve all the, problems of the last 25 years in 3 minutes.
Yes, it is. So I'd like to go back to Bob for a second. So we were talking about, or you mentioned, this question of a broker avoiding a price for a de minimis amount. And let's stipulate that we're not talking about 5310 as it sits today or shingle theory or anything but a prospective enhancement to best X. How might a broker think about high explicit costs that are maybe not transactional, but monthly or annual? How might a broker integrate those costs, which we've heard today from a number of folks are pretty profound and growing? How would those costs enter into the analysis?
Well, so baseline, 5310 is a pretty old rule. And its original formulation goes back to when there were order rooms. And so it has built into it both a reasonable judgment and then a number of factors that you look at. And one of the factors is accessibility. And the question about costs that get imposed to get there, portal costs, subscription costs, goes into accessibility. So the concept's there. The question is, what's the right level? Where's the cutoff? Yep.
Go on.
Well, so the reason I said that our best execution rule and the SEC's interpretation of the anti-fraud provisions are fraternal twins is because this is a decision for both of us. So we could say one thing and you'd say another and it does no good. So we'd have to work it out.
Okay.
I'm excited for the follow-up. So in that vein, what do you think are potential unintended consequences of modifying 611? We'll go back to you, Bob, then to Andrew, and then Debbie.
Well, I pretty much said it. So if it's not so much what you do with 611, it's what you do with the supporting rules. Because 611, the consequences have been well laid out, not identical ways, but they've been well aired in the various panels. It's which of the other rules you say, well, I no longer need that, and what do you replace it with? Those are the questions that have to be resolved.
Great. Andrew?
I think pulling the thread of 611 risks unraveling a number of things that should be carefully considered before we do them. Number of folks have mentioned investor trust and confidence. Having certainty is incredibly important for having trust in our markets. And I think that certainty applies to execution and transparency, including around even tokenized stocks. The higher cost that I touched on and others have touched on as well would likely continue from more exchanges and the existing SIP revenue model until that's changed. I worry that we'd be risking higher data and connectivity costs without offsetting benefits. And to the effect of competition, the competition I worry would only be from existing entrants in the space. Removing quote protection or trade through prohibition, excuse me, makes it harder for new entrants to come into the market. And there's that trade-off of kind of having this blank check of infinite new markets coming to the market. But closing that door really just kind of is equivalent to, in a lot of ways, pulling up the ladder behind everybody who's out here today. And Joe, just from like an economic perspective, is that something we want to do? And maybe enough is enough, but maybe that's just how we feel now. And in 10 or 20 years, we think, everybody's pencils aren't quite as sharp as they used to be. It'd be great if a new entrant came along to really shake things up, but we've kind of closed that door. So I think we'd want to find a way to make sure that that was still something that was possible. There's a bit of regulatory uncertainty. Do unprotected exchanges still face, are they still required to comply with Reg SCI? Are they still subject to access fee caps? Do they get, clearing through the DTC and SEC? The fragmentation of the rules kind of distorts the incentives, and it's not really clear how that plays out. I think we kind of need to walk through all the different permutations and the give and takes along the related rules. Best execution, we've talked about that a lot, but something as simple as 605 reports. What benchmark do 605 reports use? The beautiful thing right now about 605 reports with our current market structure is we all know they're based on the SIP. So you can actually compare across execution reports from broker to broker. When each broker has a different definition of what true north is, you question whether you can actually make comparisons across the 605 reports. And even if you said, okay, do your best X policy, but then for your 605 reports, for consistency's sake, everybody needs to use this definition, for true north. Okay, well then that's what you're really optimizing for, is that anyway, for what's in the report. I would worry that could become an incentive. Just that SIP integrity really relies on having a universal north, a true NBBO.
Yeah, I agree a lot with what Andrew just said in terms of unintended consequences. I think first and foremost, investor confidence in the market and ability to explain in particular to retail clients how you got them best X. If you don't have this, NBBO is just absolutely fundamental to that discussion. So while NBBO is not driven by 611, I think it's kind of the enforcement tool for it, and it's the measurement tool for it that's used for best X, that's used for discussions with clients. So it could get a lot harder to tell them how you got them best execution. I mean, absolutely 611 is not best X. It is one component of it, and then we go out and find the best available price or best available execution, not just price, for our clients. But I think 611 has been helpful in making those arguments with our clients. I think, some other rules, it's kind of hard because, as we've talked about, there's all these rules that interrelate, and without knowing what other strings you will pull and change and how those rules will be changed, it's really hard to know how it will impact markets. And as I said before, if you get rid of 611 and you don't change all these related rules simultaneously, I worry we're playing an experiment with a very healthy market, and I'm not sure what the reaction of everyone would be. The final thing here is I think it could make electronic trading and the associated performance reporting a little more complicated. And I think we need to think about, this isn't a reason not to do it, but it's not without cost too, because you'd have to change systems within all of the broker dealers who have built systems, as we talked about on all three panels, to adhere to 611 would have to be undone.
Thank you. So assuming 611 is rescinded, what are some of the benefits that you'd be concerned about that should be preserved? And why don't we start with you, John?
Sure. Thank you. It was tough to wait till question 5. And I think we do have 4 more questions to go, so I'm going to try to run through a lot of things quickly here. So first, I think I wanted to comment on exchanges' ability to innovate. And I particularly want to focus on there's a difference between immediately accessible and fair access. And I think we should understand that, right? Fair access denotes any market participant cannot be excluded from accessing liquidity on a venue because of how they're profiled by the venue, as what we think of as segmentation, right? Or limiting access to some liquidity. Immediately accessible is a bit of a dated term, but I think it's come up with respect to delay mechanisms, IEX in particular. Today's a formidable date with respect to, the option side of that. And I think it's really important when you think about what it means to be an immediately accessible quote. As I said in my remarks in the beginning, we live in a world where there's relative parity amongst exchanges in terms of the speed with which we operate. We talked before about the resilience of market structure. And, yes, it is hard for exchanges to innovate in ways where we can do more with one medallion, whether that be in the dimension of price, whether that be in the dimension of matching algorithms or segmentation, if it's non-displayed. But I think this concept of an immediately accessible quote is by definition an anonymous one-size-fits-all pricing mechanism that market makers use to say, all right, I don't know who I'm going to trade with, and I'm going to price that to the lowest common denominator. That's much different than if they're pricing something to a counterparty they know. And when you think of that and what the function of markets are, right, markets at their core premise should be built to help facilitate one stranger trading with another stranger when they need to. And that's such a critical part to our markets that, we need it. Do we need 16, soon to be 20? Probably not. But that's a really important part of what it means to be a market and run an efficient one. And that's the displayed liquidity piece that has been decaying, that we should all care about, regardless of what seat we sit in. I think, one thing on Best X that will play into how I'll answer the question in a second, I was thinking about this earlier, listening to what people on different panels were saying. It's almost like Best X, it's more about consistency with what it is you do than forcing conformity. And what I mean by that is, don't arb, I'm going to use a SIP here, I'm going to use a direct feed there, right? There is no, and again, this goes back to when you think of, we've talked for so many years about direct feeds and SIPs and this, that. It's just choice. It's network transport. It's you're talking about an exchange round trip time is the difference between ingesting a quote via software versus an FPGA feed handler. And it's a free market. People should be able to make those choices. And I think that when you think about it that way and you relate it to the Matt Billings retail and the Matt Connect retail, right? He's got clients that want to execute $100. He's got clients, many clients, that are giving him orders for $100 million. Those are fundamentally different things. To measure them by the same benchmark is sort of flawed, we would all agree. But we have to look to preserve the almost the social value of this price that's out there that people trust. Does it have to be overly verbose and detailed? No, but it should represent the market's best price. And as Maureen said this morning, Professor O'Hara, who maybe it's the NPGO, right? The national pretty good bid and offer, but it's pretty good, right? It represents that lowest common denominator. It is really important and critical to markets. And so I think one thing we have to think about, especially as we embark on thoughts around what rescinding 611 might look like, more so than modifying it. If you look at the rule, a lot of the statements in the rule are where a number of condition code exceptions have come from. Those are important. VWAP trade, something that was reported late. One example I've been thinking about a lot that will become very relevant, similar to a scenario Adam laid out earlier on the panel in a world we're headed into. If you think about what it costs to pre-fund a trade, I'm a market maker, and I'm going to give a price in SPY. One is pre-funded, settlable right now. The other uses centralized clearing. They very well could be different prices, right? That's a choice that the next generation of retail investors are demanding, right? It's not our place to say, no, you can't have that because it's a worse price. How do we account for that, right? We can't micromanage those things, but they need to be transparent to the world in a new and modern way where it can be understood. This is why this trade might live outside of what I'm seeing. And so I think there's an opportunity to really take a fresh look at that and refresh it. And then finally, I just want to talk a little bit about ISO trades. Someone on a prior panel talked about how we disclose order type usage and how ISOs are used in a number of different ways. Trades provide a really interesting lens. So there's a lot of ISOs that are sent to markets for non-displayed orders, for displayed orders, right? Many of them probably aren't filled, would be my presumption if you're looking across the market. But if you look at the trades in the market that are marked with F, which is the ISO condition code, it's been on the decline. It's about a quarter of the trades intraday if you take auctions out, give or take. And that's on the decline from near 30 around COVID. 99% of those happen on exchange. It's interesting, right? When you think about that. And that's because exchanges have this inability to lock and cross the market by rule. They won't. We talked about order types. Obviously, we allow clients to send ISOs from a day capacity if they've done their due diligence from their view of the NBBO to update it. But it tells us something. Like, why is it that there are so few ISO trades? Not saying that
John,
off-exchange venues don't.
I'm really sorry, but we have 3 more questions. So maybe at the very end, you can sort of finalize this point. But I think your point is well taken. I think ISOs are important for action. So Joe, would you mind also answering the question?
Sure. I think not only, we can talk about thresholds, but I think we should actually extend OPR, okay? And we touched on this before, depth of book. How does it make sense in any world where if exchange A has a 10-cent bid and exchange B has an 8-cent bid, and someone goes to clear the book, but guess what? Exchange A also has a 9-cent bid. How is the 9-cent bid at that same exchange not protected? It makes no sense, right? Well, the SIP doesn't have depth of book, right? We know that. And exchange feeds, most brokers will hit that bid anyway, but it's not protected. So if anything, we should be extending for depth of book. And I know it'll be more technically advanced and so on. It'll be a lot of data, but if you really want to have a rule correctly, you should have it in there. And it was talked about, obviously, in the 2015 panel and the MSAC. But I also like to just touch on one other thing. And I think it was Andre in the last panel mentioned that in 2005, there was 9 exchanges when NMS first started, and there were 10 ATS/ECMs. And today we've got 1633. It's really not that much different when you think about it. So maybe, just maybe, OPR is not the reason for the problems that we have today. It's coincidental that it happened at the same time. But maybe the fact that the exchange model turned into a for-profit, some public corporation model, where they have a duty now to enhance their own bottom line, order types, proprietary data feeds, co-location fees, port fees, you name it. And if you look at their revenues and their balance sheets, most of the revenue is not coming from trading. So maybe our market got distorted by the players being distorted. And maybe that's why we all go to off-exchange venues, because we're not comfortable there anymore. And one last point, again, different types of stocks require different types of solutions. When you're talking about small caps and mid caps with nickel spreads and 100 shares up, that's a lot different than an ETF that has 50,000 shares bid a penny wide. So we can't there's a different model there. And that's a whole different panel.
Thank you, Joe. Next questions are for Robert, Bob, and for Debbie. I think some of you have already spoken about this, but should the duty of best X be clarified? And, does it even depend on whether 611 is changed or not?
So I'm not a regulator like Bob, but at least since the late 90s, it's been the order receipt time quote that's been used to evaluate execution quality, not the trade time. I mean, we've been using VWAP, implementation shortfall, since the 90s for institutions. I don't know what else they're using now, but certainly, wholesalers now are being held accountable to the order receipt time depth of book quote. And that's what they're being evaluated against. So I don't see how any of that changes.
So go ahead.
No, please.
No, go ahead. Okay, I'm going to say yes and yes. I think it should. I think there's room for clarification. As Bob said, it's been around for a long time. I think in particular relative to parent orders and child orders, and we haven't really talked about that today, but indicating that we can give our clients overall best execution, maybe not in each child order, but at the parent level, is better execution for them overall than every child order having to have it. So I think that would be a helpful clarification in the existing best X rule. And then if 611 goes away, I do think that you need some changes to Best X. I think you need to be a little bit more specific. As I said, 611 is the teeth behind NBBO and executing relative to it. I would think maybe it would be worth revisiting whether you'd want something in Best X for that if you didn't have 611.
I say yes, yes. And the details depend on how this plays out. I would say our members have said to us that there needs to be more guidance on best execution in the options markets as those markets have evolved. And as was discussed before, there aren't the same supporting data, 605 data that's there. And we credit the commission on the work they've done to update 605.
Thank you. So over the past 20 years, we've seen both exchange consolidation and then some would call proliferation. How would changes to Rule 611 affect those? We heard from Andrew already, but curious from Daniel, from John, and from Cam.
Yeah, thank you. So we've talked a lot about today kind of the exchange proliferation and naturally with potential changes to Rule 611 amongst others, there's a potential really for a fundamental reshaping of the economic incentives that have fueled the proliferation of exchanges over the last 20 years. Right now, Rule 611 creates artificial incentives for the establishments of new exchanges. Achieving the protected quote status provides exchanges with guaranteed revenue through the forced connectivity, market data, and access fees without regard to new value delivered to market participants. Further, the SIP revenue allocation formula currently rewards quoting activity, even for venues with minimal trading activity, which creates a subsidy mechanism that encourages venue proliferation, absent true innovation. Repealing 611 would hopefully prompt a rationalization of the exchange landscape. Venues would be required to justify their existence through genuine value creation, and those unable to provide meaningful differentiation would likely consolidate or exit, resulting in a more efficient market structure with less fragmentation. This environment would foster more substantive innovation as new entrants would need to offer genuine improvements rather than merely meeting regulatory requirements and leveraging existing exchange technology. Importantly, and this has come up a lot in some of the earlier panels as well, we urge the Commission to maintain careful oversight of the fee filings from incumbent exchanges. The 2019 staff guidance on SRO rule filings had a positive impact, and in a post-611 landscape should be updated to ensure the continued scrutiny of market data and access fees to prevent exchanges from exploiting their market position. In sum, we would hope that these changes support a more dynamic and efficient market structure where the number of venues reflects the actual market need rather than regulatory distortions, ultimately benefiting all participants through reduced costs, complexity, and improved execution quality.
I included a couple of my answers in the response before, not knowing how much time we would have. I got two things to add here. One is, I agree, it was said by Andrew earlier, it was said on other panels. If we rescind 611 or make any significant, even if we make modifications, we do have to look at the SIP revenue share construct, right? We absolutely should incentivize displayed trades. And, I think about, Ari from Intelligent Cross was up here talking about the growth they've had. That's an example in a world where, a displayed quote, regardless of if it's behind a delay mechanism that's promoting fair access, that is resulting in trades. Maybe that's something that exchanges can do in time. Like in a world where you don't have this protected, unprotected status, things like that become easier, where we can put our money where our mouth is. I think if we do stuff like that too, we also have to look at non-displayed trades, particularly those that show up every day. 50% of the volume shows up in this omnibus way that's kind of not actionable and kind of delayed by the time you see it. So we should be looking at those things and how we can improve the market efficiency and transparency. Finally, you got to look at the bigger picture. 9 medallions across equities and options existed before late 90s, which was when ISE first was sort of the first new exchange to launch in options. Most of the new medallions, right, we're going to cross 26 with 24X. Most if not all, were started and sort of formed by industry constituents and the consortiums that they were a part of to facilitate it. And so I say that in the sense, this is a shared problem and something that, is not going to fix itself without regulators kind of getting involved and helping provide a path forward.
Yeah, so I think I agree with John that I don't think it's going to make a big impact if you eliminate OPR in terms of the fragmentation and creation of exchanges. I'm not sure that they're really driving the creation of new exchanges by itself. I mean, we've seen also proliferation of ATSs, and they don't have their own OPR, and people are still creating those as well. So it seems to be some demand out there for just new venues. In terms of the Texas Stock Exchange, again, we're not looking at that OPR or market data revenue as the basis of a business. You have to go out and earn the right to get people to connect to you. Dan showed an interesting graph earlier showing that just on this point, like that, just because of OPR, everyone's connecting to it. It seems that actually when you start a new exchange and people are a little skeptical of whether or not you're going to have material order flow, they go ahead and just hit you through a router. So I still think even in an OPR world, you still have to demonstrate that you're going to add value and that it's worth connecting directly and get those numbers. I think you said the lowest exchange had 20 or so members, but if you prove value, you can get up to 40 or 50 and get those direct connections. So I don't think, again, OPR, I think there's proliferation of the exchanges thing. I'm not so sure it's as strong as everyone's talking about. So also, I think IEX and BATS were ATSs, and then they became exchanges right after. So kind of only really have 3 or 4 new ones. So I don't know if that's like exchanges gone crazy necessarily, but I don't think we're going to see an impact there, frankly. Fragmentation is a much more complicated topic having to do with antitrust and breaking up the New York Stock Exchange in 2005, frankly.
One quick point. What's interesting about the new exchanges, and I don't want to pick on them because they're not here. 24X just filed their fee schedule, 29.5 mil rebate, no tiering. How do you think they're going to get flow? They're going to immediately capture market share, 29.5 mil rebate. I'm sure a lot of folks in this room are going to go there and post some flow. So that's how you get this fragmentation problem.
So I think we're going to shift to options now. And so we've talked about what happens if you change 611 for equities. Do you think we should make the same modifications to the options markets, at least through the trade through prohibitions? And why don't we start with Professor Battaglia with you?
All right. So I believe Commissioner Atkins said that one of the reasons for the trade through rule was to increase display liquidity. That did not happen in the equity option market. So I guess I would ask what the objective is. What is the order protection rule doing in option markets before I could answer what would happen if it was taken away?
That's good. That's a good response. John.
Sure. I think you have to look at OPR. I think outside, it's bigger than just OPR, as my colleagues on the exchange side, both CBOE and NASDAQ, were saying earlier. Options are different, and I think if you were to just remove OPR tomorrow, what would change? It's hard to predict. It's different than it is in equities. I think a lot of that has to do with the fact that we don't, there is no TRF, and you see a lot of different anomalies in it. I think one thing we're also supportive of, along with NASDAQ and CBOE, is ORF reform. I do want to state that is a meaningful driver behind what helps new medallions get going and kind of subsidize their initial launch. And the last thing is, we can't overlook the role internalization and the growth of retail is playing in this. And I think this has been a phenomenon, let's say, in the last 5 years, where you have new entrants, smaller venues, and the competition, because of the rules of options, right? Because orders are required to be brought to an exchange to be given the opportunity to be price improved, that you have competition for medallions, for internalized trades to find different models where it works for them. And some of this is on pro rata venues. Talked a little bit before about customer order priority and what have you. And I think looking at ways, again, this goes back to that innovation point. How can the commission work with the industry and us as exchanges to allow us to iterate a little bit, maybe working with market making programs and some known concepts out there like broker preferencing could have impact on that and help move us forward.
So go ahead, Matt.
I think, yeah, on the previous panel, first of all, good comments regarding options, and agreed options market is fundamentally different, so we don't want to conflate these discussions. But I appreciate the thread from the last panel regarding, one of the more effective tools the SEC has is transparency initiatives. So if you want to dip your toe into the 605 theme, and granted, that is an extremely complex statement to make because options are it's just such an immense lift, but that is an area where if you're going to take the next step with options, it's about building a transparency regime around that.
So I want to give everyone an opportunity to have sort of a final statement. So if we're running against sort of the end, so if people can give 30 seconds or a minute of your final thoughts, we can go through and be on time. So Professor, why don't you start?
I think Matt's right with regard to option markets. That would be a nice first step. Just push out 605 and let people evaluate brokers that way.
Awesome closing statement. So a couple things just top of mind as I was thinking through this. Number one, all in favor of market data reform, and I think that's trying to happen as we speak. I think we can tackle as an industry how we're going to deal with an MBBO, with rescission of 611, whatever we're going to call it. I think that's something that's part of the discussion, and it can be resolved. I heard several comments about investor confidence. Investor confidence is not achieved through a rule. Investor confidence is achieved through us. Investor confidence is us about, providing the experience, whether it's resilient platforms and execution quality and the whole experience that we want to provide to our clients. So I don't think we're going to lose investor confidence here. I think our investor confidence is going to be absolutely fine if we rescind 611. Thank you guys very much. Thank you to the Commission for the opportunity to participate in this discussion. As you mentioned, while 611 is well-intentioned, it has created unnecessary fragmentation, complexity, costs, and ultimately weighs on the investors. Thank you.
I just say again that best execution is a powerful concept, but it operates within a market structure. If you choose to change the market structure, we'll work with you to elaborate best execution.
No, I would just say thank you again for the opportunity to participate today. I mean, I think one theme that was really clear throughout all the panels is obviously as we look around potential reforms to Rule 611 as part of a wider reform to Reg NMS, it's not done in a vacuum, but instead looked at 610, market data, SIP fee revenues as well, and kind of look forward to future engagement across all those topics and maybe panels to come.
Echo that, thanks. Look forward to future discussions. I'm encouraged by the amount of openness to something. And I think, as I said to many of you earlier, the worst case outcome here would be to walk away and once again not have done anything. It seems like we talk about a lot of change. This is an area where I think we pretty much broadly agree change is welcomed. And let's remember that we can work together to solve these problems. And once again, thanks.
Just quickly on the option side, we do see opportunities to trade off exchange to help reduce costs of trading for retail institutional on the option side. And so it is worth giving people the ability to trade without getting things broken up, without this fear of how they can hedge and leaking info that happens. We keep getting asked to get into the option space. It's a big problem that people have in options today as it's growing. That just on the prior question. On the concluding remarks would again say, U.S. markets are the envy of the world. This roundtable is a great example that will just help further improve capital markets. Unfortunately, Chair Atkins 20 years ago was spot on. And there's a lot of great quotes out there, in fact, from both Jamie and Aled from years past that around doing things like minimum thresholds, doing things like block exemptions that can further improve execution quality, further improve price formation, capital formation, benefit households ultimately. And our view on Kronos is lead by innovation, lead by data, and a lot of these mandatory connectivity burdens on the industry are backfiring. And so it's worth revisiting. And we definitely see opportunity for thoughtful regulation that protects investors, but actually does allow even more innovation, ultimately benefiting households and mom and pop.
Right, two quick responses to things that was said a little bit earlier. Proliferation within the exchange versus ATS landscape. What we've seen in ATS is, by the way, is innovation and uniqueness that comes in. So we support when there's new ATSs. We have seen very little innovation within the exchange landscape, and the ones that are looking to come on board, or at least looking to be approved by the SEC, don't provide any new unique innovation or anything that we can see that differentiates them from the existing models. That's one. Two, I keep hearing things this morning and today as well where people say they achieve best X by going to get the best execution. But no one clearly defines what that best execution is. Unfortunately, that best execution is OPR, which is best price. So, when people keep referring to we achieve best X by having a robust best execution, they're referring to price. Because they're not clearly defining what best execution is other than the fact that they're achieving the price that's accessible. Closing remarks, I've heard today that it's difficult, complicated, other rules need to be changed in order to modify or rescind OPR. That's okay. We give Jamie some work if there's other rules that need to be amended, and he's up to the task. That should not be the reason that we don't address OPR. And as Vlad said and others have said, we are the envy of the world, but not because of OPR, but in spite of it.
To use Professor's analogy before, scaffolding, the building's got 16 floors of scaffolding. We can take it down 8, but the scaffolding needs to stay up. It needs to stay up because OPR is important still. Because best X is, yes, that's overriding responsibility, but investors, to that point of confidence, will feel better if they know their orders are protected. So, and then the goal again should always be, how do we increase displayed liquidity? That should be the number one reason why we're here. And by getting rid of OPR, I don't think you're doing that. I got many other suggestions, but it's not for this panel. So let's just think about that. And I think a lot of prior panels, they've always said do no harm. I think I heard that earlier. So I think do no harm on this one.
I'd echo that. At the end of the day, I think it's important to regularly reassess our rules and ensure that they're working as intended. But if the problem is exchange proliferation and it's driven by the incentives of the SIP revenue model, then it's probably worth taking a more surgical approach towards the SIP revenue cancer instead of the blunt approach that could be more costly, or disruptive. I'd be remiss to not express appreciation for this SEC's approach towards rulemaking and engaging the market and industry and roundtables and comment requests before the rule proposal phase. It's very refreshing, so we appreciate that.
I want to agree with Mehmet. I think now is the time to eliminate these rules. We really never probably needed the rule in the first place. There was very few trade throughs even back then when you had manual markets and SelectNet, which wasn't even automatic at that point either. And they still tortured the numbers enough and they only confessed about 2.5% trade throughs or something like that even then. So the cost of it just outweigh the benefits. It adds a lot of complexity as somebody who's working on a matching engine now with the team to become in the exchange. It adds a lot of scenarios and cases that really just extend the complexity of everything. And I think it makes the market more brittle too, because there's all these edge cases that you have to think about. And it also distorts trading. If you go visit, the trading firms, the ISO orders and all the hide and slide and all the gaming that goes on to try to get priority, because the market's not, is about to move and you want to be the first one at the new price level and you send the ISO orders. It's all very distorting. So then if we can do that, we can get to the place where Mehmet is describing, where an exchange can actually innovate and like the ATSs do, because maybe we can then get to the fair access, because they're sort of linked, because you kind of need fair. Once you start forcing people to access a particular price, you need to sort of regulate that interaction, right? So if we can make some progress on fair access and some of the other kind of general notions that have been out there for a long time about what it means to be an exchange and having a central limit order book, and if we can relax some of that, then we will see innovation from exchanges as well, because there's nothing different. And an ATS is just an exempt exchange. So the only difference is the regulation, not the capability of the people working at the exchanges. So thank you.
And I guess the question of whether to modify or rescind 611 requires careful consideration. And so I want to thank the Commission and Jamie and Elad for this important discussion today. I think it's, I hope, the start of an evaluation. We would hope that you'd go through a notice and comment period associated with this big of a change in addition to a roundtable. But this is definitely a good first step and a big difference from prior administrations. So much appreciated. I think the only other thing I'd share is, you know, we're talking about how over the last 20 years the markets have changed. I won't be here, but in 20 years, I wouldn't want to come back and say, did we really consider the future? And we're all talking about the past problems and the things we're fixing. I think, especially as tokenization becomes more common in our markets, I think it's important that we think about the rules that we're putting in place and make sure that we apply rules so that if we have a tokenized equity market, it is also the envy of the world and is safe for investors.
Well, thank you all. Thank you, the Commission, again for this. There's already been excellent comment letters submitted. I'm sure we're all looking forward to additional ones. But again, thank you, Director Selway, for inviting us and for the roundtable.
Thank you, Elad. Thank you, panelists. Thank you, audience here and on video. The comment file was mentioned a couple times. Let's keep that full. This will conclude the roundtable. I think Bob and I might have a late night drafting session tonight on Best X. So stay tuned for that. Thank you all once again. It's extremely helpful. Roundtables are back, and I can't tell you how much the team appreciates this level of engagement. Thank you.